The committee will come to order. Today marks the first legislative hearing in this committee in years, which highlights the importance and complexity of digital asset taxation. The digital asset status quo is untenable. America needs clear tax rules of the road to remain the crypto capital of the world. Recent data indicate that a quarter of Americans, or over 67 million people, own cryptocurrency. That's a dramatic increase from only 3% at the start of this decade. Nearly a quarter of cryptocurrency holders earn less than $75,000. And the average crypto holder is nearly as likely to work in construction, manufacturing, or food service as tech or finance. Crypto owners live in every community, urban, rural, and everywhere in between. Today, cryptocurrency has a market capitalization of over $2 trillion. That's a massive industry by any measure, and nearly all other industries of a similar size enjoy clear tax policies. The days of debating whether digital assets are a passing fad are gone. Continuing their current growth, digital assets will only become further integrated into the economy. Americans need simplicity and clarity to own, trade, and use digital assets with confidence. Digital asset businesses, many of which are homegrown American innovations, need consistent rules tailored to digital assets. Our committee's work has identified 3 key gaps in the current tax regime that make it harder for Americans to fully participate in the digital asset ecosystem. First, common digital asset transactions like mining and staking do not fit clearly into existing tax law. In other places, the tax code is silent as to the treatment of digital assets. The ambiguity creates an opening for taxpayers to exploit the law and avoid paying tax in some circumstances, and creates unfair tax burdens in others. Second, digital assets do not receive the tax benefits nor the protection from anti-abuse rules long granted to traditional financial assets. The imbalance between digital assets and traditional financial assets creates a 2-tier system that unintentionally favors certain assets over others. Third, crypto owners face burdensome tax compliance that makes using digital assets in ordinary commerce almost impossible. 31% of crypto owners would like to buy a cup of coffee at the local shop. Yet each $5 cup of coffee bought with a digital asset generates 2 new pieces of tax paperwork. As a result, the IRS gets hundreds of millions of such tax forms each year, called 1099 DAs, that do little more than burden taxpayers. The Ways and Means Committee engaged in months of thoughtful discussion to build a lasting framework for digital asset taxation. The 8 bills and discussion drafts we are examining today offer solutions to major challenges of clarity, parity, and administration of the tax code. The first bill we will examine lowers the tax burden on ordinary digital asset owners by excluding the small amount of gain or loss from tax reporting when a digital asset is used to pay network fees, like when checking out at the grocery store using crypto. This bill from Representative Rudy Yoakum extends the same exclusion of gain or loss for minor fluctuations in regulated US dollar stablecoins. Mr. Yoakum's bill also grants taxpayers who frequently use certain digital assets the flexibility to choose to provide one combined annual income calculation for digital assets, instead of calculating gain or loss on each individual transaction. Together, these policies dramatically reduce the burdensome reporting currently required of taxpayers. The second bill introduced by Representative Mike Carey clarifies the tax treatment of mining and staking rewards by treating them as ordinary income, but also allows miners and stakers to treat this income like self-created property, depending on which method best matches the timing and character of the rewards. The bill also provides a safe harbor for exchange-traded digital asset funds to receive staking rewards, which boosts the returns for Americans invested in these financial products. The next bill ensures that traditional financial assets and digital assets receive similar tax treatment. Legislation from Tax Subcommittee Chairman Mike Kelly removes the requirement that charitable donations of widely traded digital assets undergo a qualified appraisal in order to claim a charitable tax deduction. By doing so, this bill applies the same treatment to digital asset donations that already applies to stocks that are traded on an established stock exchange. Legislation from Congressman David Kustoff extends tax benefits available for traditional assets to digital assets. Our financial markets rely on these benefits to encourage foreign investment and improve liquidity. Under this bill, digital assets would be covered by the securities lending safe harbor, the securities trading safe harbor, and a special method of accounting for dealers and traders. Our hearing will also examine the application of long-standing anti-abuse rules to digital assets. These rules protect the integrity of tax filing and prevent bad actors from taking advantage of the tax code. Legislation from Representative Jody Arrington extends anti-abuse rules to digital assets so that the tax code treats investors in digital assets the same as other investors. The current landscape of vague laws paired with a high compliance burden make taxpayers fearful of correcting previous mistakes. Legislation offered by Representative Aaron Bean creates a limited one-time disclosure program for taxpayers to voluntarily come into compliance for past digital asset tax filings. This bill does not eliminate the interest on back due tax or the tax itself, but it does provide a simplified way to correct mistakes and reduces penalties for taxpayers who want a clean slate. We will also examine a discussion draft that ends a complicated scheme where taxpayers establish residency in a territory and then take advantage of complicated regulations to avoid paying capital gains tax on digital assets. Digital asset taxation does not have to turn into a partisan fight. I want to note the leadership of Congressman Miller and Congressman Horsford in showing digital asset taxation can be addressed in a bipartisan way. Representative Horsford has brought forth a discussion draft that looks at issues regarding mining and staking rewards and the charitable deduction. Other countries like Singapore and Switzerland have already implemented comprehensive tax regimes that offer clarity to digital asset owners. Congress must act now and enact clear tax rules to ensure America remains the global leader in digital assets. If Americans want to pay with a stablecoin instead of a credit card or cash, they should be able to without a pile of tax paperwork. If a hairdresser, a gig worker, or a small business owner wants to accept digital assets as payment, they should not be treated any worse from a tax perspective than payment in cash or credit. Our tax system should not be picking the winners and losers. That is why these bills focus on removing the tax advantages and disadvantages for Americans who use digital assets. I want to thank our expert witnesses for being here, and I look forward to our discussion today. I'm pleased to recognize the ranking member, Mr. Neal, for his opening statement.
Thank you, Chairman, and thanks to our witnesses for being with us this afternoon. We are here to address the taxation of digital assets, which have taken quite a bit of the committee's time this year. In light of many of the struggles that are taking place for the American family, I hope that we will also be able to devote more time to the price of gas, groceries, energy, housing, and health care, which continue to soar, and we want to be involved in finding solutions to those problems as well. Notwithstanding that observation, I'm glad to see that the majority is holding this legislative hearing. We're wading into a novel topic with a degree of caution, which is an important consideration. If there is one thing that I can say that is bipartisan for sure, it's the need for more education on this topic of digital assets on both sides of the aisle. One of the most important questions that face all of us is the level of risk and who eventually will underwrite it. We have before us 6 bills and a discussion draft, and my initial observation is that there are some aspects of these bills that are quite sensible, providing clear rules of the road for taxpayers looking to comply with the law. Other provisions sought the common sense goal of alleviating burdensome paperwork requirements, especially in situations where it's highly unlikely that there would be any tax associated with those transactions. And indeed, there are provisions that would close loopholes that are specific to the digital asset industry, another goal that I think we all share. At the same time, it appears there are some provisions that deviate substantially from general tax principles, providing a distinct advantage that are beyond some other investments. We want to be careful about putting a thumb on the scale, and as we all know, it's much easier to put something into the tax code than it is to take it out. I hope that we will consider building the necessary buffer as it relates to the element of risk that I highlighted just a moment ago. Mr. Chairman, you stated that the goal here is to have a strong bipartisan piece of legislation. I'm aligned with that goal eventually. There's healthy skepticism on both sides, as evidenced by the fact that there are still large numbers of Congress members who don't comprehend all of the questions that we are currently discussing. Let me also single out Stephen Horsford, who's been a leader on our side, and he's been quite engaged in these negotiations. This hearing's a good step. My suggestion is that we listen carefully to our witnesses and bring up many of the various concerns on all and both sides of the questions and across the aisle. There is only one way to truly develop a bipartisan product, and that is to hear what has to be said, but also understanding the role, as I have mentioned twice already, where risk might take us. Thank you, Chairman.
Thank you, Ranking Member. I will now introduce our witnesses. Ms. Sarah Riley is Vice President and Senior Tax Counsel for Fidelity Investments. We have Mr. Lawrence Slotkin is Vice President of Tax for Coinbase. We have Mr. Jason Somansato is the Director of Policy for Coin Center, and Mike Kircher is Deputy Director for the Tax Law Center at NYU Law. Thank you, each and every one of you, for joining us today. Your written statements will be made part of the hearing record, and you each have 5 minutes to deliver remarks. Ms. Riley, you may begin when you're ready.
Chairman Smith, Ranking Member Neal, and members of the committee, thank you for the opportunity to testify today on the need for digital asset tax legislation. My name is Sarah Riley, and I'm a Vice President and Senior Tax Counsel at Fidelity Investments based in Boston, Massachusetts. I'm an attorney in the corporate tax group focused exclusively on digital asset tax issues. Thank you to the committee for its leadership, diligence, and foresight in undertaking the complex task of crafting tax legislation to bring much-needed clarity and certainty to the digital asset ecosystem. I appreciate having had the opportunity to work directly with many members on the committee and their dedicated staff over the past year. Your time and focus on these issues has been extraordinary. And thank you for the opportunity to appear before you today and to share Fidelity's perspective on digital assets and the importance of implementing a modernized tax framework. If enacted, the proposed legislation would remove tax-related barriers to U.S. innovation and competitiveness in the digital asset space, allowing for blockchain technology to flourish in the United States. For over 80 years, Fidelity has been focused on helping our customers invest and build financial security. Today, we serve millions of investors across retirement, brokerage, and workplace benefits with $7 trillion in assets under management. Fidelity offers unique perspectives in the digital asset space, As one of the only established large financial institutions actively involved in the digital asset ecosystem, we are a bridge between traditional finance and digital assets. Fidelity has been engaged in the digital asset space for more than a decade. We began research and development on digital assets in 2014 and have supported customers' access to digital assets across institutional and retail channels since 2018. Fidelity now supports customers with respect to digital assets across custody, trading, retirement accounts, exchange-traded products, payment stablecoins, and blockchain research. That experience gives us a well-informed view of where existing tax rules map well to digital assets, where they do not, and where legislative clarification is needed. As digital assets play an increasingly important role in the U.S. financial system and broader economy, the tax code must be modernized to provide taxpayers with clear, consistent, and administrable rules. Although the impact of tax uncertainty may have once been viewed as affecting primarily crypto-native market participants, the increasing use of blockchain technology in traditional finance has expanded its relevance. As a result, the lack of tax clarity affects not only those directly involved in the crypto space, but also the financial sector at large. For example, tokenized securities and payment stablecoins all run on blockchain. Most tax code provisions that could potentially apply to digital assets were written before the broad adoption of, and therefore without contemplating digital assets, and the limited amount of sub-regulatory guidance addressing digital assets has proved wildly inadequate. General tax principles are a useful starting point, but cannot address the full scope of new challenges and complexities introduced by digital assets, including how to accommodate the broad range of use cases. Clear and administrable tax rules consistent with existing tax principles are needed to address issues that are unique to digital assets and blockchain technology, such as timing, character, and sourcing of validation activity and rewards, and the tax treatment and reporting of payment stablecoins, and areas where digital assets are similar to traditional investment assets but face disparate treatment, such as in the context of U.S. securities and commodities trading safe harbors, mark-to-market accounting, and non-recognition treatment for securities lending transactions. Absent legislative action, tax uncertainty has real and harmful consequences. It undermines taxpayer confidence and exposes taxpayers to unnecessary risk. It can produce inconsistent taxpayer outcomes and create opportunities for more sophisticated taxpayers to take aggressive positions. It makes compliance more challenging, particularly for those without access to specialized tax advisors, and it incentivizes the offshoring of innovation and infrastructure, impairing U.S. competitiveness. On behalf of Fidelity and the millions of customers we serve, we appreciate the invitation to share our views and contribute to this important dialogue. We commend the tremendous work of the committee in putting forth a tax framework that would address key areas of uncertainty in the digital asset space and provide a critical and much-needed foundation for taxpayers while balancing the priorities of clarity, parity, and administrability. We look forward to continuing to work with the committee to implement a modernized tax framework for digital assets. Thank you.
Thank you, Mr. Slotkin. You may begin when you're ready.
Chairman Smith, Ranking Member Neal, and distinguished members of the committee, thank you for the opportunity to testify today. My name is Lauren Slotkin. I serve as the Vice President of Tax at Coinbase. Before joining Coinbase, I spent nearly 25 years as a corporate tax executive at General Electric. During that time, I learned a simple lesson that applies to every market, every taxpayer, and every industry. When tax rules are clear, people comply. When they're unclear, complexity grows, costs rise, and economic activity moves elsewhere. That principle is especially important for digital assets. Today, millions of Americans own or use digital assets, yet much of the tax code still treats this technology as though it were a niche experiment rather than a growing part of the financial system. The result has been confusion for taxpayers, compliance challenges for businesses, and unnecessary burdens for the IRS. I want to commend Chairman Smith, Ranking Member Neal, the members of this committee, and the bipartisan staff who have spent years working through these issues. The legislative bills before the committee represent the most comprehensive effort to modernize digital asset taxation that we have seen to date. Most importantly, this legislation recognizes a fundamental reality. Market structure and tax policy go hand in hand. Market structure sets the rules of the road. Tax policy determines whether Americans actually choose to use that road. The Clarity Act is moving through the Senate, but this committee shouldn't wait on the tax side. Clear tax rules will strengthen the emerging market structure framework, and further delay only pushes activity, capital, and innovation offshore. The legislation contains several important highlights. First, it brings common sense treatment to payment stablecoins. Genius Act compliant stablecoins maintain a one-to-one relationship with the US dollar, requiring taxpayers and the IRS to track gains and losses on transactions that generally produce little or no economic gain creates significant administrative burdens without meaningful tax revenue. The deemed basis framework included in Congressman Yakim's bill is an important step forward towards making stablecoin payments practical while reducing unnecessary reporting noise. Second, the legislation recognizes the unique mechanics of blockchain networks by providing relief of small validation and network fees. Every blockchain transaction requires these automated infrastructure costs. Treating every small network fee as a taxable event creates complexity far out of proportion to any revenue impact. The committee's approach is a meaningful step toward aligning tax rules with how technology actually functions. Third, Congressman Kerry's bill provides long-needed clarity for mining and staking rewards, helping ensure taxpayers are not forced into tax obligations before they've generated liquidity through an actual sale. This improves administrability while supporting domestic investment blockchain infrastructure. Finally, we appreciate the committee's discussion to pair taxpayer relief with market integrity measures, including wash sale and constructive sale rules, while providing a reasonable implementation period for brokers. While we strongly support the direction of the legislation, we believe several targeted improvements would strengthen the final product. First, Congress should go further by establishing a personal transaction de minimis exemption for all digital assets, including Bitcoin. Congressman Yakim's bill removes tax friction on network fees, but a consumer who uses Bitcoin to buy a pair of jeans still has to calculate and report a capital gain. That's not good tax policy. Americans shouldn't need an accountant to buy jeans, and the IRS doesn't benefit from tracking millions of transactions that generate little or no revenue. Second, Congress should ensure that any future international reporting requirements are carefully coordinated with existing U.S. reporting frameworks so that American businesses are not subjected to duplicative and conflicting compliance regimes. Mr. Chairman, the legislation before the committee demonstrates that we do not have to choose between strong tax compliance and technological innovation. We can achieve both. By modernizing the tax treatment of digital assets, Congress has an opportunity to provide certainty for taxpayers, reduce administrative burdens, strengthen compliance, and reinforce America's leadership in the next generation of financial infrastructure. I believe the bills before us are a vital step toward that goal. Thank you for the opportunity to testify today. I look forward to your questions.
Thank you, Mr. Somansato. You may begin.
Chairman Smith, Ranking Member Neal, and members of the committee, I thank you for the opportunity to testify today. My name is Jason Somansato, and I am the Director of Policy at Coin Center, a nonprofit focused on cryptocurrency and public blockchain policy. For several years, former Secretary of Defense Donald Rumsfeld sent the IRS a letter with his tax returns. The 2014 version read, "As in prior years, I have absolutely no idea whether our tax returns and tax payments are accurate." This is amazing because I doubt Secretary Rumsfeld even used Bitcoin. Taxes are already complex. Crypto tax compliance is even harder, in part because our tax system assumes that most financial activity runs through intermediaries that can track, summarize, and report transactions for their customers. That assumption may work tolerably well when the people use banks, brokers, and payment processors. It breaks down when Americans use open cryptocurrency networks that were designed to allow users to transact directly with each other. That is the core problem before the committee. A tax system should collect what it is owed, but it should not require Americans to give up the freedom to use open networks simply to make tax compliance practical. The current reality is that crypto users are expected to maintain detailed records of virtually every transaction, track changing market values, determine the tax treatment of very complex activities, and calculate gains or losses on transactions that may be only worth a few dollars. What often feels like sending a simple electronic payment, using an app on a phone, or receiving a reward in a video game can trigger tax consequences that require substantial record keeping and analysis. The result is perverse. A technology that is designed to reduce reliance on intermediaries can become difficult for ordinary Americans to use unless they turn back to the intermediaries simply to manage tax paperwork. For this reason, Coin Center is encouraged by the committee's work here today. The bills being discussed make progress toward three key reforms that Coin Center has recommended for years. First, Representative Yakim's Less Tax Paperwork for Digital Asset Owners Act would reduce the compliance burden on individual taxpayers by exempting gains from certain stablecoin transactions and gas payments. Congress has long recognized that some transactions technically produce taxable income, but are not worth the administrative burden required to measure and report them accurately. The point is not that these transactions are outside the tax law in theory. The point is that the tax system has never realistically expected ordinary Americans to perform capital gains accounting for every low-value exchange of personal property. If someone sells an old rug on Facebook Marketplace, they usually do not stop to calculate the basis and gains on that transaction. If a 12-year-old trades baseball cards with a friend, we don't expect her to file Form 1040s. We strongly recommend that the committee also consider extending the exemption to low-value transactions in non-stablecoin cryptocurrencies like Bitcoin, modeled after the personal foreign currency transaction exemption. The tax code should not privilege certain types of cryptocurrencies over others. Whether someone uses stablecoins like USDC or Tether, or cryptocurrencies like Bitcoin, Ether, and Solana, a reasonable de minimis rule should protect taxpayers from gotcha consequences on small transactions. Second, we are encouraged by the exploration of a simplified accounting election for taxpayers who engage in high volumes of crypto transactions. Coin Center has advocated for a mark-to-market style election because it could substantially reduce tax complexity for many users. In contrast, Coin Center does not support applying wash sale rules to cryptocurrency transactions. Those rules are a poor fit for open cryptocurrency networks, just as they are for most commodity-like assets, and would create substantial new compliance burdens. If Congress nevertheless imposes them, the simplified accounting election offered by Representative Yakim would be an essential mitigation and not a substitute for getting the underlying policy right. Finally, we appreciate the committee's effort to clarify the tax treatment of block rewards in the Tax Clarity for Mining and Staking Act from Mr. Kerry. Coin Center has long argued that newly issued cryptocurrencies awarded to validators should be taxed when sold or exchanged rather than when created. This approach better reflects the reality of block rewards as newly created property and fixes a fundamental mismatch between current IRS guidance and the mechanics of how these networks actually operate. In short, Congress can make crypto tax compliance simpler without creating special tax preferences. It can preserve tax enforcement while removing traps for ordinary users. And it can do so without forcing Americans back into the intermediated system that open networks were designed to make optional. Thank you, and I look forward to your questions.
Mr. Kircher, you may begin when you're ready.
Chairman Smith, Ranking Member Neal, and distinguished members of the committee, thank you for the opportunity to testify today. As someone who follows this space closely, I hear a lot about how we need to write rules of the road for taxing digital assets. This is a helpful metaphor, but I might tweak it slightly. The tax system is built to be adaptive to any economic activity or new industry, and that includes digital assets. So when we talk about the need for metaphorical rules of the road, in tax, the road already exists and it already has rules, but new industries and structures can create potholes for the tax system. Left unchecked, these potholes can turn into sinkholes that beget massive tax shelters. Policymakers should look out for these and address real problems we've seen as the digital assets industry has grown. And keep in mind the first rule of road maintenance: don't make the roads worse. As these bills progress, I encourage policymakers to consider 3 tax policy principles most closely: parity, administrability, and guardrails to prevent abuse. Some of the provisions in these bills would make improvements consistent with these principles. For example, one of the bills would extend anti-abuse regimes like wash sale rules and constructive sale rules to digital assets. That's a good idea. Another example is the de minimis provision on qualifying stablecoins. A targeted approach with guardrails can reduce paperwork and compliance burdens without creating substantial hidden tax subsidies for digital assets. But the rule should remain targeted because a broader de minimis provision risks abuse and would favor investments in digital assets over those in traditional finance. There are some provisions in these bills that do provide subsidies or create risks of abuse. Take, for example, the bill addressing the treatment of mining and staking rewards. These rewards are payments in digital assets for validating transactions, similar to the income earned by a notary for validating documents. First, the bill makes explicit the current rule that rewards are taxable when earned. That's the correct policy, and it's already the law. It's consistent with long-established tax principles. It's consistent with Section 61 and the IRS position. It's consistent with how income from other similar activities are treated, and it's consistent with a correct tax court ruling from last week, which found that staking rewards are taxable on receipt, rejecting the taxpayer's arguments as moot, irrelevant, or without merit. The problem is that the bill then provides an election for stakers and miners to defer income paid in the form of newly minted coins until disposition. This violates parity with traditional finance and the principle that income is taxed on receipt. Economically, it functions as an interest-free loan from the government. Here's one example of how this could play out in the real world. The Clarity Act would allow consumers to earn deposit-like interest on stablecoin balances held in accounts. If Clarity and deferral become law, consumers will get a better tax result by investing in stablecoin accounts than in high-yield savings accounts at a bank. Deferral would become a new tax subsidy, encouraging investment in digital assets relative to other types of investment, risking deposit flight from banks into accounts that lack important FDIC insurance. Deferring tax on mining and staking rewards isn't just a distortive subsidy, it could also undermine administrability. Deferral increases complexity for taxpayers and makes it harder for the IRS to do its job. The government will need to write new rules. Taxpayers will need to track and trace various aspects of transactions over many years. It would be simpler for everyone to tax the income upon receipt, consistent with normal tax principles. Deferral on mining and staking rewards also creates risks of abuse. Despite some thoughtful guardrails in the bill, it may be possible for taxpayers to permanently escape tax by earning rewards through certain business structures. This would convert an interest-free loan from the government into a loan that never has to be paid back. This is a better tax treatment than even what traditional retirement plans offer. Here's my final point. To date, industry has properly identified some of the potholes. The wash and constructive sale rules are good examples. But if you're out fixing potholes that others have flagged, it's worth fixing the other ones you see along the way. For example, the risk from non-compliance for digital assets operating on decentralized finance networks remains high. If we can't find a way to improve transparency and compliance for DeFi, it will remain difficult for honest taxpayers to pay what they owe. And DeFi will be a favored tool for tax evasion and illicit finance. Thank you for the opportunity to testify, and I look forward to your questions.
Thank you. We'll now proceed to the question and answer session. Many participants in the digital asset market are not large financial institutions or wealthy entrepreneurs holding digital assets for sophisticated investment purposes. They are everyday Americans. Digital assets can provide a low-fee alternative for Americans to access payment systems, savings, and investments without high fees, credit checks, or deposit minimums. Digital assets can also provide instant payment for small business owners at a fraction of the cost of traditional checks or wire transfers or even traditional credit card fees. The Coinbase Institute has data that suggests 1 in 5 American adults own crypto, and 70% of owners make less than $100,000 per year. Mr. Slotkin, when it comes to tax policy, this committee has prioritized everyday working Americans. How do the reforms that we are considering benefit working families, and what are some of the key challenges that they face that these bills address?
Thank you, Mr. Smith, for the question. There are a number of provisions in the legislation, I think, that benefit small taxpayers and small businesses. You mentioned stablecoins. Stablecoins are innovative. They're a transformative method of payment, and they have the ability to essentially create much more efficiency for the entire payment structure. So a small merchant, for example, can use them much more effectively than existing systems. So I think stablecoins are a good example of that. We have de minimis rules that are in the proposed legislation. The de minimis rules take away a lot of the clutter. We heard a lot about record keeping, about the need for that. And I think that alone solves a lot of problems. We have an alternative mechanism for calculating gain or loss, which benefits small taxpayers for small persons who can use that for their businesses, so that essentially cryptocurrency is accessible for just about everyone. So I think the great aspect about the legislation itself is it has a number of provisions that simplify, reduce clutter, and promote the use of cryptocurrency for the efficiencies that I think they were intended.
Thank you. Financial markets need clear rules of the road. To make it easier for Americans to access digital assets, we must provide greater tax clarity for those who make these networks run. This includes individuals who engage in mining or staking to validate the blockchain and are rewarded for that work with newly minted digital assets. Certainty is also important to ensure America remains the global digital asset leader and encourage foreign participation in our domestic markets. Mr. Somensato, how confusing is the current tax treatment of mining and staking rewards for the individual taxpayers involved? And how will addressing issues like timing and sourcing of the income derived from mining and staking enhance the ability of the U.S. to remain the crypto capital of the world?
I think in my written testimony, I cited to a survey that related to the confusion that users of Kraken, one of the large exchanges in this environment, face when dealing with taxes. And it was something along the lines of like 89% of individuals reported some level of confusion. And a large portion of that was related to how to manage something like a staking reward. So I think fundamentally you have a very large subset of the population that is interacting with these technologies that have expressed this frustration and this confusion. And I think the bill as proposed does a really important job of not just clarifying how that's going to be treated for them, but recognizing that that treatment aligns with what an individual who is using this technology probably assumes when they are performing a validation technique. Just for a little context, a user who might be a solo staker on the network, meaning they just want to participate in the validation process to support the ability for everybody to transact peer-to-peer, is essentially just interacting with their computer in the same way that a lot of us would interact with an app on our phone, as I mentioned in my opening statement. And for them, the idea that newly generated tokens that are coming from no one, there is no one that is paying them, there is no compensator that is on the other side, should be taxed right at the moment that they receive them is kind of contrary to what you would imagine in similar circumstances. Take, for example, an athlete who signs an autograph to a piece of, like a book that they're writing. Well, they don't assume that the moment that they put their autograph to that, even if it is more valuable out on the market, that they now owe taxes on that, right? The creation of that value is done by the staker, and recognizing that with the legislation in the way that it does is very important.
We must ensure that the IRS can administer and enforce tax laws while not imposing undue reporting burdens on taxpayers complying with the law. Right now, the current system is a far cry from that. It's estimated the IRS last year alone received hundreds of millions of Form 1099 DAs for digital asset transactions that taxpayers are already required to report on their tax return. Even though up to half were for amount less than $10, the current system creates an immense burden for taxpayers and the IRS with little tax revenue to show for it. Ms. Riley, how does this flood of tax filings and paperwork impact not just brokers or IRS personnel, but those participating in the digital asset market? And how do these bills' provisions on gas fees, stablecoins, and simplified accounting methods for taxpayers help address that burden?
Thank you for the question, Chairman Smith. I think one thing I'd like to focus on is that just beyond your general crypto transactions, as blockchain technology proliferates, you have an increasing amount of even just general financial activity happening on blockchain as an alternative to the traditional rails of finance. So transfers of tokenized securities, transfers of stablecoin, they all trigger these micro transactions of transaction fees, which results in voluminous tax reporting to taxpayers that may not even fully comprehend why they are getting tax reporting for, they're imagining, oh, I'm transferring a tokenized security, but I'm also getting this microtransaction with minimal gain or loss as well. So it adds a level of complexity and challenges on the administrative side. In the proposed bill, the exemption for transaction fees under $10 eliminates a lot of the noise and the friction that occurs in this space with very little impact to tax revenues, especially with the preservation of the unrecognized gain that goes into tracking.
Thank you. Digital assets do not necessarily fit into existing rules and regulations. In some parts of the tax code, standard definitions simply do not apply, while in other parts, the application of the law to digital assets is unclear or confusing. For the sake of simplicity for taxpayers, we should be looking at how to bring digital assets underneath the umbrella of existing tax law. Mr. Kircher, how would you look to using existing rules governing traditional financial assets, and how do the policies we are considering today on like charitable giving or access to U.S. markets for foreigners help individuals and entities find balance between digital assets and similar financial assets?
I think that's a great question, and thank you, Chairman Smith, for it. Focusing on the charitables concept that you were mentioning, I think the bill takes a really thoughtful approach, right? For the largest digital assets, the ones that are widely traded, you are able to use a spot price under your bill in order to value for charitable donation purposes. That's way simpler than the current rule where you actually have to get an appraisal. And that appraisal system is not ideal for widely held digital assets, A, because the appraisal is costly, but B, because it's subject to potential risk of abuse. As you know as well as anybody, valuation issues in charitable space have become quite a problem in other spaces, including syndicated conservation easements. And so I think the amendment that was issued last night takes an additional step to further use the market for price discovery, requiring the sale of the assets rather than relying on appraisals that are both burdensome and risk getting into the wrong answer.
Thank you, sir. I now recognize the ranking member for any questions.
Thank you, Chairman. I'm pleased that you noted the fact that there are ambiguities that we would like to use our panelists to help clear up. So, Mr. Ketcher, in reading your testimony, if you don't mind, I want to ask you, as you spent some time on some of the allotted questions that we have, you pointed out that providing that those who receive staking rewards with the ability to defer recognizing income on those rewards has the potential to create real imbalance in our financial system. Can you explain in more detail on how this tax advantage could potentially encourage people to move their money out of traditional banks and into cryptocurrency, consistent with the discussion we've had here clearly about establishing rules of the road?
Thank you, Ranking Member Neal. It's a great question. I already mentioned the kind of example of a high-yield savings account and how deferral would put digital assets on a better footing than a high-yield savings account. So that's one kind of issue. But imagine that you're an investor saving up for retirement, housing, whatever, and you're thinking about, say, corporate stocks or bonds, right? If you get dividends from a corporate stock, that's taxable when received. If you get interest from a corporate bond, that's taxable when received. If you get dividends from corporate stock, that's also taxable when received. Deferral would be a better treatment than either of those and would tend to push people from traditional financial instruments into digital assets ones. And as you know better than anybody, tax rules can really shift markets and tell people kind of where they should and shouldn't invest.
Mm-hmm. The follow-up, just as you've noted, I think one of the biggest concerns I've had, which have been shared with the panelists in the past, we've done some really good work on this committee with retirement savings. And I think being mindful of exposure to anything that might be disruptive has to be done with the greatest of care. And I point that out largely because we're living longer, we want to live better, and I think in the retirement space alone, that a lot of scrutiny has to go into the conversations and suggestions that are emanating from not just the testimony of our panelists today, but from some of the points that our members have made. And if you think that people are angry given the savings and loans issue or the issue of the collapse of Wall Street in 2008, my God, if this isn't done with great delicacy, you'd be looking at a revolution. So that's the point that I want to make, Mr. Chairman.
Thank you, Ranking Member. Mr. Smith.
Thank you, Mr. Chairman. Certainly thank you to our witnesses as well. Obviously, this is a complex and rapidly evolving area, a significant portion of our economy these days. And we know that while technology is changing, one point is certainly clear, and that's Congress cannot afford to ignore developments occurring before our very eyes. As policymakers, our responsibility is not to pick winners and losers, but to provide clear rules, promote compliance, and ensure American innovation can thrive here at home. I appreciate our witnesses joining us here today and helping the committee better understand industry priorities, challenges facing taxpayers, and opportunities to improve our tax code. This committee has seen firsthand how tax policy affects American competitiveness. Before enactment of the Tax Cuts and Jobs Act, the United States remained one of the highest corporate tax rates in the developed world, while other countries adopted competitive tax regimes. I like to point out that even President Obama recognized that our rate needed to be modernized to stop capital formation and jobs from being offshore. Congress acted, we modernized our tax code, improved competitiveness, and corporate inversions largely disappeared. There's an important lesson in that experience. Innovation does not stand still while policymakers debate. Capital, talent, and investment gravitate toward jurisdictions offering certainty and stability. Today, digital assets present a similar challenge. Regardless of one's view of cryptocurrency or blockchain technology, these innovations are likely to remain part of our economy and become more integrated into everyday commerce. Entrepreneurs, developers, investors, and users need clear rules of the road. When uncertainty persists, investment moves elsewhere. The U.S. already leads the world in capital markets, financial innovation, entrepreneurship, and technological development. We possess the infrastructure, talent, and investment ecosystem necessary to remain the global leader in digital assets as well. I appreciate President Trump's commitment to maintaining American leadership in this sector, and Congress has an important role to play. Our goal should be simple: establish clear, workable tax rules, encourage compliance, promote innovation, and ensure digital asset investment, jobs, and infrastructure continue to be built in the U.S. rather than elsewhere. I look forward to hearing from our witnesses today in discussing how Congress can provide certainty for taxpayers while strengthening America's position as the world's leader in digital asset innovation. Ms. Riley, I noticed then and pleased that Tax Clarity for Mining and Staking Act would establish clearer sourcing rules for staking rewards, potentially onshoring significant staking activity back to the U.S. This simple fix in the tax code will go a long way in driving growth for U.S. crypto, bolstering the tax base, and making crypto safer for users. I was wondering if you could explain the benefits of establishing clear sourcing rules for staking rewards in order to attract more staking activity here at home.
Thank you, Congressman, for the question. I think sourcing has been a critical area of ambiguity with validation rewards generally. Under the existing tax principles, it's unclear exactly how you would source them, and that uncertainty has been incentivizing offshoring of much of the infrastructure for staking and validating. Having a rule such as in the Tax Clarity for Mining and Staking Act provides clarity that the income should be sourced to the resident of the recipient. That ensures that U.S. staking providers can be on a level playing field with non-U.S. Staking providers, such that the income is sourced to the resident of the recipient regardless of where the infrastructure is located. Sourcing rules need to be based on factors that can be both clear and administrable and also not easily manipulatable. and having them be based on things such as location of the validator results in significantly different tax outcomes based on immaterial differences.
Okay, when you say not easily manipulable, I think I said that right. Can you say what we should maybe focus on there?
I think it's basically removing it shouldn't be based on where exactly the validators are located, where the people are located. Those are things given in the cloud environment can be easily moved offshore. And we already see that happening where staking providers can move their infrastructure offshore. They can shift that, validation activity offshore. And
so public policy wise, your priority would be what?
Would be to source, if by sourcing to the residence of the recipient, there's a clear rule that you can identify the jurisdiction for tax more easily and not have to go through a facts and circumstances analysis for each income.
Great. Thank you very much. I yield back.
Mr. Doggett.
Thank you. Mr. Karcher, am I correct from your testimony that the mining and staking legislation before us does not even the playing field for crypto, but it gives it special tax advantages?
That's right. Under current law, as affirmed by the tax court last week, those rewards are taxable when earned.
And is there any doubt that, as you pointed out, not just this legislation, but combined with the Clarity Act, legislation that the crypto industry has invested literally tens of millions of dollars to gain approval for, that the goal is to strengthen and expand the crypto industry?
I can't speak to the goals, but I can say that that would be the effect.
The effect, okay. And as far as effects, your written testimony lays out how the legislation that's before us could set up another multi-billion-dollar taxpayer bailout of the type we had a few years ago that I opposed. Would you just walk us through how crypto could become kryptonite for our economy?
I think one thing for policymakers to consider on this is that if digital assets become a larger part of retirement accounts and the assets remain highly volatile or in a worst case scenario crash, that would have an enormous impact on households' retirement savings. And if that were to happen, I think policymakers would have to think about whether to respond with something like a bailout.
As you know, one of the big players after having condemned crypto years ago in crypto is President Trump and the Trump family. The Wall Street Journal has indicated that World Liberty Financial, just one of the family's crypto ventures, has put at least $1.2 billion in cash into the Trump family's pockets in the last 16 months. And Eric Trump, of course, has American Bitcoin, a Bitcoin mining company that hit a $13 billion valuation when it went public. Mr. Karchner, is it true that one of the bills before us would let a company like American Bitcoin and the Trump family members who own it, in essence, to defer their taxes indefinitely?
That's right.
And does this provision that you've discussed as far as illicit finance, what we know to have been the experience with Bitcoin, Binance, I guess, allegedly having helped Hamas, Hezbollah, Iran's Revolutionary Guard, and others move so much money, $1 billion, I believe, across its platform, tens of millions to it after October 7th itself.
That's right.
That's right. So with reference to any of these, we got 7, 8 bills before us. Does a single one of them do anything to reduce the danger of illicit transactions and more misuse by Iran, Hamas, Hezbollah in misusing these accounts and avoiding any accountability?
I don't think that anything in this bill would improve safeguards and guardrails on that level. I think that's something that policymakers should consider as the legislation progresses.
Well, you would think that in the long months of this that some consideration would have been given to it. Would strong tax reporting requirements help the IRS and law enforcement clamp down on this illicit activity, including illicit activity not only by terrorists and criminals, but just your common, ordinary tax evasion of the type we have had alleged against President Trump himself?
Yeah, tax reporting and collection can absolutely reduce the risks of tax evasion or illicit activities. And I think that there's more to be done here.
And can that be accomplished in a fairly straightforward way so as not to encumber any of those who believe in crypto?
There's certainly precedent for it in traditional finance. We already have rules that do just that. I think that you would need to think about whether they fit the decentralized finance framework, but I don't think it's fatal. I think it's workable. You just need to figure it out in a slightly different way.
Thank you very much for your testimony. I yield back.
Thank you, Mr. Kelly.
Thank you, Chairman, and thanks our panel for being here today. I don't think there's anything more confusing than what we're trying to transfer into how the currency works. From the day people started trading livestock for something else, and we got on and on and on, and now we've gone through this currency thing. One of my questions is, or the piece that I have, is an amendment to the 1986 code, 40 years ago, when it comes to charitable giving and the exemption for people on charitable giving when they use this type of currency to trade it. So, and I'll be the first one to tell you, I have been mystified now for quite some time as to the creation of this, the birth of this whole idea. We have a new currency to deal with. But the question is always going to come from the government is, how do we tax it? How do we figure this out? How do we get it taxed? Mr. Zlotkin, can I ask you, from the perspective of charities and donors, does the current appraisal requirement, on top of the current appraisal requirement, create a meaningful barrier to charitable giving? And would the framework proposed by the committee help address that challenge? And before you answer that, when we did the original Tax Cuts and Jobs Act, I can remember one of our members coming in and talking and saying, you know what, we've got to be careful what we're talking about when it comes to this charitable, because I got a lot of people who I represent are questioning the fact, why should they continue to make charitable donations if there's going to be a tax inference to that? And the answer was, that really shouldn't bother people. If they really want to give to a charity, it shouldn't matter. And they said, really? Watch the numbers go down and then tell me it doesn't have an effect. So if you could, Mr. Slott, because I think this is a very confusing thing, if you can bring some light to it, what can we do? What would the framework proposed by the committee do to help challenge that? I mean, we have to figure out what we're going to do with it and how we're going to tax it or not tax it, or what we're going to do.
Thank you for the question, Congressman. I think the bill, first of all, I think one of the things we've argued very strenuously is for parity with the rest of financial services, that this industry is $2 trillion. And we need rules of the road. We need some clarity associated with that. One of the aspects of that happens to be charitable giving and charitable donations. Right now, if an asset is publicly traded with great frequency on a public exchange like Coinbase, and you can get market data instantly from your phone, you still need an appraisal to give that to charity. That is an inherent impediment to charitable giving. If you have to go in and hire someone to do something that you can just essentially establish on your phone. So one of the great advantages of the bill actually is that it introduces parity with publicly traded stocks and it's widely traded digital assets. Widely traded digital assets as defined, which include lots of safeguards and protections so that they only apply to assets that have price discovery on public exchanges, rules against self-dealing. All those things are dealt with, and they provide a rule of clarity that you don't need to go and get an appraisal for that. So I think, to your point, it greatly enhances and facilitates the ability to make charitable donations.
Yeah, I agree with you on that. I think if we make it more complicated for people to be charitable, we're missing the whole point of being in America. So I appreciate you all being here today. This is as we transition and go into this, some people understand this very clearly. But I'm looking at it strictly now from a charitable standpoint. If you have an asset that you can donate and make sure that the charity benefits from it, I don't know why we'd have to go through this other process. So I appreciate your answer on that. And as we go forward, we're going to have a lot more discussions, I'm sure. This is not the way we're all used to things happening, but I'm sure this happened also in prior times when people tried to figure out how this is working and how does currency work, or the lack of currency, or what it is that we do. And so if you have something that's valuable and you want to help a charity, why not be able to do it without having to do this whole process? So I appreciate you all being here today for helping on something that's, I think, as we transition to it, we'll get more used to it. We'll look at it more the way we look at other assets. So thank you so much.
Gentleman yields. Mr. Thompson, you're recognized.
Thank you, Mr. Chairman. This is an important hearing, and I'm glad that we're doing this. These are critical issues, and we need to make sure we get it right. And I really want to associate myself with the comments of Ranking Member Neal, especially on the liability issue. We'll probably be going back and forth on the tax side of things for as long as any of us are here. But on the liability issue, that's going to be critical. And we need to really make sure we understand that and don't leave the taxpayers holding anybody's bag. Mr. Karcher, I was reading through the testimony, and I was particularly interested in the tax treatment of mining and staking awards. Seems to be a real sticking point in all this. And it seems that maybe we're at an impasse on where we go and how these issues are viewed. Some folks are telling us that mining and staking rewards are basically the same as payment for work in the case of mining and interest payments in the case of staking. And others tell us that it's the same as self-created property, like growing crops, growing grapes. Can you kind of help us sort through the distinction? And in your view, what's the better analogy?
Thank you, Mr. Thompson. It's a really good and important question. This has really become a little bit of a battle of analogies, right? But let's step back for a moment and talk about what's really happening with these transactions. So miners and stakers, the validators who are receiving those rewards, what they're getting rewarded for is not for solving a complicated math problem in the case of mining or for putting up their staked crypto in the case of staking. They're getting paid in order to update the digital ledger to record who owns what. So it's really a payment for service when you think about what's happening here. That's not like harvesting your own crops or selling your own chair that you made as a furniture maker. And that, I think, is crystal clear in the tax court's holding from last week. I think an important part about that case is the tax court decided to issue that as a tax court memo. That format is normally reserved for cases where the current law is extremely clear and well settled. And so they didn't seem to think that there was a lot of ambiguity here, and neither do I. We have argued at the Tax Law Center for many years that the current treatment is immediate taxation, and it's more like providing a service rather than harvesting a crop.
Thank you very much. Mr. Chairman, I'll yield back.
I want to thank the witnesses for being here today. And this is a very important topic, as the chairman said. And as we work towards solutions here, I think we have to figure out a consensus on the tax rules for the digital asset industry. And some members of this committee might view the digital asset industry and the blockchain as the next technological breakthrough for the financial services industry. And some might view it as a complete Ponzi scheme, and maybe there are opinions somewhere in between. But regardless of opinion about the industry or the asset it produces, it should not preclude this committee from writing clear tax rules. For an industry that has the same global market capitalization as Amazon. One of the major flaws in the current digital asset environment is the requirement for separate reporting for every transaction, no matter how small or routine. This burdensome for taxpayers and administratively inefficient for the IRS has left many taxpayers, brokers, and the IRS spending dollars to track pennies. Mr. Zlotkin, I understand Coinbase is a stakeholder that struggles with these same issues. I think we've discussed this, millions of tax records for very small amounts. How do you think the bills we are considering today help address this issue?
Thank you, Congressman, for the question. I think the bills go a long way towards solving that problem, and they reduce a lot of clutter for the system and allow the IRS to focus on what it should be focused on, which are large transactions that produce lots of income. So if you look at Coinbase, and I've said this repeatedly, probably half of our actual submissions on 1099-DAs are for transactions that are less than $100. So, and that we're talking about 800 million transactions that we force the IRS to ingest through data. So the bills, to the extent that they eliminate stablecoin reporting, which is probably half of that amount, and they provide a de minimis rule for what we call gas fees or transaction fees, that's the bulk of what I'm talking about. So I think just by doing that alone reduces the enormous amount of clutter that the IRS faces and allows, again, as I said, the IRS to focus on the bigger picture.
So I think what you're referencing is something that we talk about often here is the inefficiency or the efficiencies of the IRS. And clearly, if we can reduce that burden, we're not going to stop the use of cryptocurrency in the United States Congress. I mean, that's not what we're here to talk about. We're talking about how to tax these transactions, whether they be classified as currency or property. And so if the IRS is having to monitor these, if we can create a de minimis situation where there are literally millions and millions of transactions that are not having to be monitored by the IRS, we're going to free them up to do other things that they're rightfully should be doing with the technology and the people they have. I think another issue we're aware of as it relates to the taxation of mining and staking rewards is timing. And another issue, however, is sourcing issue. And I think we talked about this a few minutes ago. In the Tax Clarity for Mining and Staking Act, the source of income from newly minted digital assets is based on the resident of the recipient at the time of the income is included. For each of you on the panel here, and you bring a lot of knowledge in this space, do you think this is the right approach for the sourcing perspective? If you can give us a simple yes or no, that's great. If you want to elaborate, we can maybe in just a second, but Ms. Riley.
Sure, yes, and I think any other policy would continue to incentivize offshoring of validation activity and would also adversely affect U.S. competitiveness.
Mr. Zlotkin.
Yeah, I totally endorse that, and I think we've advocated for that for a while. In fact, we've gone to the IRS and sought ruling on this very point. The simple fact is that and this really is attracting foreign investment into the country. We want foreigners to be able to stake on U.S. platforms. Right now, if a foreigner wants to stake on the Coinbase platform, we have to essentially tell them that everything that's done for that staking validation mechanism is done offshore, with offshore infrastructure, with offshore people, with offshore aspects of Coinbase. The reason being that they don't want any entanglement with the United States. What this source rule does, very simply, it says, if you're a non-U.S. person, you get non-U.S. treatment, you're not subject to withholding tax. End of story. It solves that problem. It allows us to bring the technology onshore where it belongs and where we can grow it in the United States.
Mr. Samasado?
Yeah, I would agree with the comments of the earlier witnesses.
Okay, Mr. Kircher?
The residency-based rule would, I think, make the rules much clearer. There are different approaches to this, and there are trade-offs among them. Would be happy to follow up with you or your staff on those trade-offs and different approaches.
One last question here. Brokers and dealers of securities and commodities can use the current mark-to-market accounting method. No current option is generally available for brokers or dealers of digital assets. That's why the PAR Act aims to provide parity between digital assets and other traditional assets by allowing digital asset dealers and traders to utilize mark-to-market accounting. Mr. Zlotkin, Mr. Samasado, does extending the mark-to-market accounting to dealers or traders of digital assets make sense to you?
Yes, I think, again, the bill is named parity. I think parity, this is something we've also argued for rather strenuously over the many years. Parity with financial services, so we don't create an advantage for one industry versus the other, is extremely important. So allowing mark-to-market, and also there are other aspects of parity, including securities lending, various aspects that create parity of various rules, increase liquidity, and acknowledge the strength of this industry. I think all those go a long way towards helping and do a very good job of doing that.
Mr. Samasado?
Yeah, I would just add that I wouldn't limit it to traders and dealers. Truthfully, the nature of how this technology works is that people can make numerous transactions in a small period of time. And one of the parts of Mr. Yakim's bill would consider kind of a similar accounting method as it applies to individuals who are involved in a high frequency of transactions. And I think that makes a lot of sense, particularly from an administrability perspective.
Mr. Larson, you're recognized.
Thank you, Mr. Chairman. I want to commend everyone for their testimony and also for the bringing up this extraordinary concept. I don't know how many Americans are, totally comfortable with this, but what I like to start is it's impressive to read what all of you had to say is, how comfortable do you feel with Congress making a decision?
I'm happy to jump in there.
Yeah.
I was just I think in the alternative, the question is, what does the alternative look like right now? And as individuals—
Well, if you're at Augie and Ray's, what does the alternative look like?
I can tell you from personal experience and from anecdotal experience with lots of people who participate in these networks, it's pretty nightmarish. It's
pretty what?
Nightmarish.
Okay.
You can engage with these networks in a variety of ways. We often talk about the ability to make payments in a peer-to-peer manner, but there's also the possibility to post social media posts that require paying a small amount of transactions. There's video games that are associated with digital assets. All of that activity comes out to the end of the year, a huge long list of transactions that the average taxpayer who's doing this kind of from a personal capacity.
Do you feel that Congress is equipped and has enough knowledge and information to act accordingly?
I think for some of these targeted pieces that we're talking about today, there's been a lot of discussion over the years. We've put together a 60-page report after 60-page report on a lot of these concepts. And so I wouldn't necessarily say we need to change
With
the
all
whole
due
tax
respect
code.
to the 60-page reports, I'm sure they're thorough, et cetera. That's not what I'm asking. Do you think that people in the country, et cetera, I think this is an important issue. And I think that your remarks and testimony, whether it's 60 pages or 600, they certainly raised a lot of questions. I think Mr. Neal raised probably the most critical one, but I'm curious, Mr. Slatkin, what's your take on this?
I think it's incumbent upon Congress to do something. I think
So
we
you
need
think
rules.
it's that urgent that we act now?
It's a $2 trillion economy that has
Right,
very
so-
few rules.
And the
Correct.
urgency is, again, I'm talking to a guy at Augie and Ray's in East Hartford. So what's the urgency for him to act?
The fact that he may not know the rules of how to report income, he may not know the rules.
So a guy who's trying to make ends meet in this economy, et cetera, he feels that sense of urgency about this, and that if Congress doesn't act to say, well, protect his Social Security as opposed to this, you think that that's more urgent?
I don't think it's a choice between Social Security and tax policy.
What's it a choice between?
I think tax policy is extremely, and this technology
Complex.
also serves the underserved, like people who are not banked, who can actually therefore not pay enormously
So
big
I guess the point
gas
I'm
fee.
getting at is trying to convince the public, as is going to be the case in trying to convince Congress about the urgency and what are the underlying safeguards, et cetera. And all of you, I think, are very bright and capable. Ms. Riley, what about yourself?
I think just to reiterate some of the other points, I think that we're existing without a full tax framework. And I think this increases abuse, which can reduce compliance, which does harm the fisc. I think that by having rules, you can increase compliance. So it would affect everyday taxpayers in that you want people paying their fair share. Tax fairness is very important, and you need a workable tax framework to achieve that.
Mr. Karcher.
Here you're taking two incredibly complicated topics and kind of smushing them together, right? You've got digital assets, very complicated, and a lot of education that needs to happen, and then tax, right? Also very complicated with a lot of interactive effects that are sometimes intuitive. And so I think that there is a really important factor of making sure that the members are educated and really understand what they're doing before acting.
And probably the most important thing is that we get it right, right? And so I think there's kind of a consensus building around this that it's an important industry. It's certainly, there is a sense of urgency, but there's also a sense of, are we acting too quick without knowing what we're doing? And when I say we, I'm not talking about you. I'm talking about the United States Congress, who represents the public. So I guess color me. I think this is a promising industry with other, but there's far more questions than there seem to be answers to that give you the confidence that we've got it right just yet. And this is a lot of good work done in these bills as well. But I think it's going to take a lot of public hearings and further hashing out. Yield back.
I know it would shock the gentleman to say I applaud our chairman for starting this bipartisan task to try to figure it out, because I think your original question was a great question. Is Congress prepared? Right. And the answer is probably not yet. Not yet. Ms. Miller.
Thank you, Mr. Chairman. And I do want to thank Chairman Smith for calling this legislative hearing. And I want to thank you all for being here to discuss the important issues. The digital asset market has grown rapidly over the last several years, and we are at a crucial moment where tax clarity is needed to ensure that the United States remains the crypto capital of the world. Without a clear administrable tax code, digital assets will be pushed offshore and give advantage to foreign adversaries and weaken our financial stability. As the digital asset market continues to grow, more and more taxpayers have entered this space. However, due to confusion, ambiguity, lack of clarity, as highlighted today, some digital asset owners may have underpaid taxes due. These taxpayers may be afraid to come forward and report their mistakes, fearing that the IRS may impose harsh penalties on what was otherwise well-intentioned activity, or maybe even regret those less well-intentioned activities that they're coming forward and willing to pay what their due is to start having a clean slate. That is why the Digital Assets Voluntary Disclosure Program Act would direct the Treasury to provide a voluntary disclosure program for taxpayers who failed to comply with tax laws related to digital assets to come back into compliance, as well as providing reduced penalties and a clean slate in the process. Mr. Samansato, do you think that taxpayers could benefit from a program like this, given the lack of clarity regarding the taxation of digital assets in the recent years?
Yes, Congresswoman. I think crypto tax has evolved over the years through notices and FAQs and enforcement actions. And so going to the gentleman's questions earlier, it puts the individual taxpayer in a very difficult position of people who are already engaging in this technology and want to engage in it. And I think from the perspective of trying to bring the clarity that people are talking about here today and provide that framework that will allow people to proceed forward, it necessarily needs to come with an understanding of what the last decade plus has looked like for a lot of individual taxpayers. And so I think that voluntary disclosure program is really important. I guess I would even add too, and this is not necessarily part of the bill, but the opposite is true too. For those of us who are like nervous about the tax consequences of what we do, I'm sure there's tons of us who have put everything at a zero basis because we have no idea really what we're looking at or when we're going to potentially. And so, creating that level playing field for everybody and also allowing the consequences, understanding the nature of the consequences from before a period where Congress has been clear about what it wants is really important.
Thank you. It is clear that the status quo is burdensome and confusing for the digital asset industry, and without legislation, the problems will only continue. I am looking forward to continuing to work on these issues with my colleagues to ensure that tax clarity and parity allows the United States to remain the global leader. But we all will have a lot of questions moving forward. I thank you and I yield back.
Mr. Davis, you're recognized.
Thank you, Mr. Chairman, and thanks to all of our witnesses. Mr. Cantor, welcome back to Ways and Means. As my constituents are struggling under the Trump-inflicted crushing cost of higher rent, health care, food, gas, and goods, I question the appropriateness of gifting hundreds of billions of dollars in costly tax breaks to industry firms and wealthy crypto holders. As the president creates a $1.8 billion trust fund to give to January 6 rioters, and now is trying to take over all federal grants to gift his friends and wealthy buddies billions more in taxpayer dollars. I'm frankly shocked that our committee is once again seeking to gift billions in tax cuts for the wealthy. I understand the need to create meaningful rules of the road that create parity among similar assets. But in my estimation, the bills before us today fail to help working families while giving billions in tax breaks and loopholes without the necessary guardrails to prevent abuse, all the while privileging digital assets over other types of assets. So, Mr. Catcher, could you talk about the most important guardrails for digital assets in this tax space? That is, guardrails to protect consumers, prevent abuse, and promote parity among similar or other kinds of assets.
Thank you, Mr. Davis. I would probably focus on three things. The first is don't create unintended subsidies that will push people away from traditional financial investments into digital assets. You really do want true parity. I think the second thing I would say is you should extend anti-abuse frameworks from traditional finance onto digital assets as appropriate. You see that in some of these bills with the wash sale and constructive sale rules. And then the last thing I would say is I think there's worth study on the digital asset or crypto tax gap. A lot of crypto is now subject to information reporting that is really helping taxpayers in the IRS more easily find the right answer. There's simplification that can be done, but in general, the structure works. There's a huge slug of digital assets that still do not have any transparency or reporting. The problem with that is that without any kind of reporting, based on prior research in other spaces, you should probably expect less than half the tax paid or less than half the tax owed to be paid. So you should expect compliance below 50% or right around there without something in the space. So I think that's really important.
Let me ask, do we see a great deal of risk for the average consumer, the average working family? What does this really mean for them?
I think your average consumer or family still even today, despite the growth of the industry, doesn't have investments in this area and so aren't really directly affected. There certainly are families who do. The industry has grown quite a bit. Regardless of whether you're invested in this space or not, though, if there are subsidies that get built into this law, including deferral, that is something that all taxpayers have to pay for, right? Deferral isn't free. We have to borrow today to pay for any deferred taxes owed tomorrow. And so I think that's something really important. You might be somebody who's not even in this industry, but if deferral or something like that that is an improper subsidy would happen, there's a question of who pays for that. And I think it can be consumers and families.
Is there much likelihood that any of their assets might get entangled and they end up losing?
If you encourage through subsidies the investment in digital assets and the economy or in that part of the industry goes poorly, absolutely there are risks there.
Thank you. Now you're back, Chairman.
Thank you, Mr. Schweikert.
Thank you, Mr. Chairman. I apologize for my tardiness. We're down the hall actually arguing over water. Can you imagine that being from Arizona? My question is actually, one of the bills here is actually trying to sort of have a discussion on de minimis. You know, what would actually make it in parity to traditional finance? Do any of you actually feel you have a level of expertise or comfort to walk through a quick discussion on the de minimis language we have? Raise your hand, let me know. All right, discuss it with me. So if I have my network fees and those things within this, I'd had de minimis bills in the past, agreed they might have been hyper simple. What would you do? Are we going the right direction?
I think you're definitely going in the right direction. I think the areas of stablecoins and gas payments that have already been identified are important areas where a de minimis exemption would work. I think understanding the purpose of a de minimis exemption is really important. It's not a means to say, hey, we're going to ease the tax compliance requirements on you. I think an important concept that somebody else told me is the tax regime needs to meet the taxpayer where they are at. And right now you have many people making very small transactions involving cryptocurrency. And the over-criminalization of that activity, if you don't pay it right, creates an environment in which everybody is a tax cheat.
Yeah,
so,
and you also have the problem of just even if it wasn't about that, it just compliance cost becomes.
That's exactly right. And so taking from the concept of like a foreign currency transaction, it wasn't that we wanted to say, hey, we're incentivizing people to go buy euros and then buy a croissant when they go to France on their trip. It is a recognition that when people traded into euros and then went on vacation and bought something, we could not expect them to do that capital gains estimation and pay those taxes, and that they weren't going to. And I think that is why we think at least that the de minimis exemption should go further to cover some of these assets like Bitcoin, where there is a very real economy for using it in small payments.
So you make the distinction between stable Bitcoin and the network fee?
Correct.
Okay. Anyone else have an opinion on this? Yes, sir.
I strongly endorse that. I also would say, so if you look at one spectrum, stablecoins are right now subject to tax. They're treated as digital assets. Disposition, use of them is impeded by virtue of that. There's no gain or loss associated with that. A substantial amount of reporting, both by consumers, by retail users, and by us as a broker, have to be reported that way, as though those are taxable transactions. When you do that, you prevent the potential growth of stablecoins as an enormously powerful payment instrument that essentially provides average consumers a much more effective means with fewer costs, including fewer costs for less advantage to be able to, who don't have access to the banking system. So you have that. A lot of our industry is based on gas fees, network fees. They're less than $10 or often less than $1. Those also have to be reported. So we're essentially transferring a lot of focus, attention of the Internal Revenue Service on something that is not going to generate much taxable revenue and impedes our growth overall.
And okay, you basically went where I went. I have somewhat of a concern that is our language robust enough to make it clear that we don't want to create a lot of noise. And so often we've actually had this thing where we're getting lots and lots and lots and lots of data, and there's really no tax collection benefit to it. And in many ways, if there's bad acts, it gets lost in that much noise. Also, I want to make sure, Mr. Chairman, that as we design this, if there's a value, a reduction of friction in being able to use the technology for transactions, therefore eventually lowering costs to consumers and to the retailer, I want that, because I actually believe if there's lots of these transactions, sorry, your network fees, those things will actually be competed down. And so that's just why I've always had a little fixation here on what we call de minimis, is if it doesn't bring us tax dollars, let's make it as efficient as possible. And there's some ways to design leakage and anti-fraud protection. And with that, I'll yield back, Mr. Chairman.
Thank you. Ms. Sanchez.
Thank you, Mr. Chairman. I appreciate the opportunity for all of us to talk about crafting a new tax treatment for digital assets. And while there are some provision in these bills that I think makes sense, I do want to express my concern about one proposal, which is the unlimited deferral for newly minted digital assets. As everyone here knows, these assets are becoming more popular in the U.S. economy, with nearly 1 in 8 Americans holding some form of digital tokens. But we have a unique opportunity here to create a new tax treatment for a new type of asset, and I really don't want to do that with inequities that are built in. As we've seen time and time again, wealthy taxpayers can use loopholes to enrich themselves. To that end, I would like to see some of these bills incorporate changes before they go forward to a markup. Mr. Karcher, you spoke in your testimony about how deferral violates parity with other industries. Could you talk a little bit about what problems you foresee that unlimited deferral for mining and staking would create?
That's a great question. I think unlimited deferral is particularly at risk of being pernicious because of how the rest of our tax system works. So if you were able to hold on to digital assets that were earned until death and then pass them on and get stepped up basis, that's not deferral anymore, that's elimination of tax. Now, the bills today have guardrails against that. They would say when you get rid of, dispose of your assets, they would be taxed at that point. I think the bill language solve some of the transfer at that stuff, but not completely. Because if you were to earn the rewards through an entity like a partnership, and that partnership that then gets held off to your kids, I'm not sure that the bill text actually prevents kind of game playing to, again, convert deferral into elimination of tax permanently.
Thank you. I appreciate your answer. I know that we've talked a lot this afternoon about comparison between these assets and traditional financial products. I want to make sure that these new tax treatments don't give any advantages to the digital asset industry, because that kind of deferral is a huge tax benefit and a huge departure from current tax policy norms. I also want to discuss the opportunity to increase some anti-abuse guardrails, because these tokens can be volatile. I want to make sure we have adequate anti-abuse provisions in place. And I was glad to see the inclusion of some wash sale rules and constructive sale rules, but we have a ways to go in terms of anti-abuse. In Congressman Horsford's Digital Parity Act, we have a higher threshold for charitable giving. And because of the volatility of these tokens, I believe that stricter guidelines around charitable giving are necessary in order to prevent fraud. Mr. Karcher, do you agree with that?
I think that you can actually kind of get both administrability and anti-abuse here at the same time, right? If you're able to leverage the market for price discovery by allowing spot price for really big digital assets, that's a win for everybody. And then there's a question of what to do with the less widely traded ones. There's a real risk for abuse there where the valuations can be manipulated. So if you either require the taxpayer or the charity to sell those assets and find out with the real market what the true price is, no more appraisals needed, nobody has to pay for that, and you have more certainty that you're avoiding abuse.
Great, thank you. As this committee knows, we had a bipartisan product with stricter anti-abuse frameworks, and I am glad to see the inclusion of some provision from Congressman Horsford's Digital Parity Act included in these conversations, and I would hope that my Republican colleagues would support them. I look forward to hopefully seeing more of those included so that we can create a lasting bipartisan tax framework with those stricter anti-abuse guidelines. And with that, I will yield back.
Mr. Estes.
Thank you, Mr. Chairman, and thank you for our witnesses for being here today to provide your expertise on an issue that directly impacts everyday Americans, our financial institutions, and our nation's competitive edge. As we sit here in June of 2026, the digital asset market has reached a staggering $3 trillion. Roughly 14 to 30% of American adults now own or interact with crypto. The United States represents 18% of the global digital asset revenue and commands over a third of all Bitcoin mining operations. But despite this momentum, the industry is operating in a regulatory vacuum. Current tax code never envisioned these cutting-edge technologies and forces digital assets into rules that don't explicitly mention them. The result is a lack of clarity and parity for digital assets, along with an administrative nightmare. System now is the equivalent of a highway with no guardrails to keep cars from running in the ditch. If we don't establish some clear rules of the road to provide certainty, consistency, and simplicity, accidents will continue to happen. Consider the sheer scale of the paperwork burden on everyday uses of digital assets. For the 2025 tax year, IRS required hundreds of millions of 1099 DA forms. According to brokers, half those forms were for transaction amounts below $10. That's completely unworkable. Forcing a taxpayer or a broker to calculate capital gains on a micro transaction every time they buy a cup of coffee or interact with a blockchain protocol doesn't protect against tax avoidance and abuse. It just creates a mountain of red tape that stifles everyday commerce and innovation. Furthermore, our system for digital assets lacks parity with traditional finance. Important tax rules and familiar frameworks that govern traditional equities and financial institutions don't apply to digital assets simply because they didn't exist when the laws were written. Look at the difference between tax anti-abuse rules between digital assets and traditional securities. These longstanding rules around wash sales and constructive sales that protect traditional securities don't apply to digital assets. Extending these rules to digital assets ensure they are not treated better or worse than similar financial assets and provides consistency and clarity for investors and traders. Tax uncertainty is already pushing the crypto industry offshore, directly advantaging our foreign adversaries who are eager to replace the U.S. financial leadership. It's incumbent upon Congress to provide the standards that will allow the industry to thrive here in the United States and not cede the future of digital assets to China. Without U.S. authored standards and definitions, capital, innovation, and jobs will flee America. We must streamline the tax code to ease the burden on everyday Americans, brokers, and the IRS alike when dealing with digital assets. Our legislation needs to establish crucial guidelines that will allow innovation while protecting investors and taxpayers. Yeah, I look forward to being able to have some conversation around the legislative proposals. Mr. Slatkin, the data showing that half of all 1099 DA forms in 2025 were transactions less than $10. It's an administrative burden, as has been mentioned before. From a broker's perspective, how does this high volume of microtransactions impact your operations, and how the changes proposed in legislation we're reviewing improve compliance and relieve the administrative burden for both the consumer and the IRS?
Thank you for the question, Mr. Estes. I think it imposes enormous administrative burdens in terms of creating systems, data, things that we have to do essentially to report both to our customers, educate our customers, and then file that information with the Internal Revenue Service. We should not be focused on hundreds of millions of transactions that are, let's say, $10 or less. I don't think even the average taxpayer understands why we would have to do that. Their presumption is that those transactions should not be, are just not within the tax net at all. So I think the legislation goes a long way to solving that problem. It solves it for stablecoins, which don't even generate gain or loss. It solves it for de minimis transactions. We could probably expand it further, but as a starting point, this is an enormous benefit overall. I also want to reiterate something you said, but I think has gone unstated here. We are not here for a subsidy. Okay, I just want to make it clear that I did not come here to Washington to ask for a subsidy for our industry. And I really object to the terminology being used here as though we're asking for a subsidy. We're asking for clarity, rules of the road, so that our customers know how to report transactions. Yep. We want administrability, clarity. And so that's what really we're asking for.
All right, thank you. You know, the amendment to H.R. 9175 is premised on the notion that the draft left open the opportunity for significant abuse. However, the JCT score shows that the amendment would only net $6 million over 10 years compared to the base text of the bill, proving a very slow potential for abuse. Mr. Kersher, your remarks mentioned additional guardrails like studies on additional market cap thresholds or annual trading volume would it be necessary. But doesn't comparing the score on the amendment from JCT show that the potential abuse is minimal?
I'm not an economist, so I don't know what's behind that JCT score, but I know that historically when you look at what's happened in the charitable space with respect to appraisals, there's a significant amount of risk in the system if you don't have good guardrails, and this is again one where you can get to a much more administrable and cheaper answer for taxpayers by leveraging market transactions rather than appraisals.
Thank you. Now yield back, Mr. Chairman.
Thank you, Mr. Chairman. I want to thank all of our witnesses. Mr. Karcher, as the ranking member of the Oversight Subcommittee, I am really concerned on how the IRS will administer any proposed changes to the tax treatment because of crypto. Given the fact that the IRS has lost substantial staff and leadership capacity, what should the IRS be doing to demonstrate that they will be capable of implementing any of these changes? And does Congress need to consider providing more resources to the IRS if any crypto package passes into law?
The IRS has been significantly defunded, and that's a real problem from implementing any new law or legislation or new systems required, including the changes to reporting that would make life simpler for users and for the IRS. So I think there's a bipartisan history of, in bipartisan bills, adding IRS funding for implementation, and that seems like something that could be worth further study and could be appropriate.
Yes. You know, the tax treatment of mining and staking has rightfully received a lot of attention today. In your testimony, you highlighted parity concerns about deferring tax on mining and staking. However, you also highlighted that the administrative challenges and increased complexity of having to track those transactions over multiple years is a problem. Can you elaborate further on why deferring tax on staking would administratively be challenging, and does this increase the potential for abuse?
I think there are two elements here that create complications. One is that folks who receive rewards will have to bifurcate the reward. So they'll get a slug of newly minted tokens, but they'll also potentially get fees. And you have to distinguish between those two and treat them differently. And then, because you don't tax the rewards until disposition under the bills, that could be very many years. That could be 40 years for somebody who's 30, 40 years old right now and engaging in these transactions.
Yeah. One of the reasons why I think a lot of us were particularly concerned about this indefinite period of deferral and how that can be abused. I'd like to ask you, Ms. Riley, you've talked a lot about the various complex issues that crypto bring up, and you suggest proposed legislation. Can you talk a little bit about how we can best deal with the potential fraud and abuse that can happen with indefinite deferral periods?
I think the important thing is when crafting any rules around indefinite deferrals, making sure that there aren't loopholes or opportunities to perpetually or indefinitely defer. Like, I know we're saying indefinite, but there should be limits on the ability to transfer or do anything under any of the other non-recognition provisions of the code.
Yeah. One of the provisions that Mr. Horschmidt's bill is to do a 5-year window. And your thoughts about whether or not that, I guess the year could be extended, but the point is indefinite doesn't seem like it seems to me a non-starter. But can you talk a little bit about whether or not you think the 5-year window would be appropriate?
Sure. I think one helpful analogy to look at when you look at the election, for instance, is it's similar to the rules that govern 83B elections, but the reverse. I think one factor, although there are many similarities between 83B election scenarios and this, is typically when you have a person that is deciding not to make an 83B election, there is some vesting window for those transactions in the agreement. Here, we don't have similar facts, so I understand, the deferral window is trying to provide some equivacy there. So I can understand kind of that position.
Yeah. Mr. Karcher, I wanted to also, in your testimony, you talked about the crypto asset reporting framework. Can you elaborate on why this framework is an important part of any package for crypto, and why that framework would provide the kind of clarity and oversight, provide us with tools for anti-tax erosion, and how we in Congress can help to push for a review at OMB so that we can implement such a framework?
Absolutely. These are extremely mobile assets, right? And so it's hard to know where reporting is going in some cases. CARF would try to address that by creating global standards. And they would really help both on tax evasion, but also on anti-money laundering, anti-terrorist financing, and other kinds of safeguards that aren't necessarily tax, but also potentially for tax. They've been sitting at OIRA for many months now.
Yep.
I'm not sure what the holdup is, but normally they deal with those within 45 days. So some oversight could be appropriate.
Yeah, before I yield back, I'd like to just again reiterate with what Ms. Sanchez said, that I think that there's some room for bipartisan support on crypto, and I look forward to this committee allowing for such bipartisanship to occur. Thanks.
Thank you. I now recognize myself for 5 minutes, and I do want to thank Chairman Smith for convening the hearing. I want to thank all of you for appearing, not only for your oral statements, but for your very thorough written statements. Ms. Wiley, if I could with you, and I did review your statement along with the other witnesses, under current law, digital assets are often not clearly eligible for long-standing tax benefits that are available to traditional financial assets. We've talked about that in the hearing, and you all have talked about that, including the safe harbor in Section 864 of the Code and the securities lending safe harbor in Section 1058. Yesterday, I did introduce a bill that Chairman Smith referenced. The title of it is the Providing Analogous Rules for Digital Assets Act, the PAR Act. The bill number is HR 9176. What the bill is intended to do would be to extend the existing safe harbors to digital assets so that foreign persons can invest in the United States markets without being treated as engaged in U.S. trade or business, and taxpayers can lend assets without triggering a taxable event analogous to current treatment for securities. My question to you respectfully is, does the trading safe harbor for digital assets in this PAR Act that I've just described to you do anything different than the current safe harbor available for other financial assets in Section 864, or does it simply put digital assets on an equal footing?
Thank you for the question, Congressman, and thank you for your introduction of that bill. Much appreciated. The trading safe harbor in the PAR Act merely extends the same safe harbor currently available to securities and commodities to digital assets. And this really puts U.S. Digital asset brokers, asset managers, and custodians and similar on a level playing field with non-U.S. competitors. And the tax policy reasons for those trading safe harbors in the securities and commodities context should apply with full force in the digital assets context as well.
Thank you. If I could, and Mr. Zlatkin, if I can with you, perhaps Congress would create a digital asset under the PAR Act, lending safe harbor that's intended to closely track Section 1058 framework for securities lending so that a qualifying loan of digital assets is not treated as a taxable sale. If we can look at it at lending, can you walk us through how this Section 1058 style safe harbor digital asset loan would operate in practice or in practicality and how it would benefit?
Thank you, Congressman, and thank you for introducing the PAR Act. Section 1058 is a very critical feature of the crypto economy. It allows participants to lend digital assets without risk that will essentially be a taxable transaction. It's a core aspect of our financial services industry with securities lending. One of the first projects I worked on when I started at Coinbase was to try and obtain a ruling from the Internal Revenue Service that existing law applied to digital assets. We were unsuccessful in doing that, but essentially it creates liquidity and it provides the parity that you just described. What it does is it allows me to lend a digital asset to you, and that loan is not a taxable transaction. It's restored to me with a fee, for the borrower pays a fee for that, and I enjoy the same benefits that I had before I loaned it. So it essentially just acknowledges the aspect that it's a non-taxable transaction and puts you at a level playing field with the rest of the securities industry. It's today, despite the absence of law, again calling for clarity, hundreds of billions of lending of this type occurs today at great risk to those taxpayers who don't enjoy the benefit of the provision that you introduced.
Thank you very much. Thank you to all the witnesses. I'll yield back my time and at this time recognize Ms. Chu.
Mr. Karcher, I think the Tax Clarity for Mining and Staking Act contains one of the most consequential and controversial provisions our committee is currently considering. And that is that taxpayers who receive mining or staking rewards could elect to defer taxation on those rewards until they dispose of the underlying digital assets. And there is not in this proposal any maximum deferral period allowing miners or stakers to defer their rewards indefinitely if they choose. Now, supporters of this provision argue that mining and staking rewards are more comparable to an asset or to inventory and therefore should not be taxed until they are sold. An alternative characterization would be that mining rewards are better analogized as a payment for effort taken by taxpayers to verify transactions on the blockchain. Thus, they are more akin to labor income more than anything else. So, Mr. Karcher, what do you think is the correct characterization? And therefore, how should these rewards be treated?
I think really what the compensation or the rewards are for is for validating and updating the ledger and who owns what. And that looks a lot like a service, just like a notary when they're stamping a document, just like an accountant or somebody else who's keeping a ledger. And so it feels like a service. And I think that's completely consistent with the IRS's position. It's consistent with current code section 61. It's also consistent with the tax court case from last week that made the point emphatically clear that under current law, those rewards are taxable when earned.
And therefore, what would your recommendation be as far as a period of time for taxation?
As a pure tax policy matter, I think that deferral is inappropriate. I can imagine various reasons why this industry would need potentially or want potentially some short-term deferral to deal with liquidity. I know that the Digital Parity Act has thought a lot about that. If you were to do a short-term deferral, I would encourage it to be quite short, as low as a year. But I can understand the idea that it's hard to have a cash tax payment without having ever converted the money to cash. So, yep.
And one rationale is that the industry portrays miners as small entrepreneurs, but there are only 3 companies that control the majority of crypto mining for Bitcoin. Given this market domination, what compliance concerns do you have regarding this kind of indefinite deferral for large-scale, sophisticated Bitcoin mining companies?
I think a lot of the tools that have been used for tax avoidance over the many years would continue to be able to be exploited in an indefinite deferral situation. There was obviously an amendment that would potentially limit deferral to 4 to 5 years. That would create less opportunities for abuse. If you're allowed to hold until disposition, then you're going to see a lot more ability to use tax structures to not just defer the income, but to eliminate it from income entirely forever.
Thank you for that. And Mr. Karcher, I wanted to follow up. I know in your testimony you talked about the charitable deduction for digital assets, and the act that is before us would allow digital asset donations to qualify for an exemption from the independent appraisal requirement if the asset has a market capitalization of more than $500 million. In your testimony, you suggested that Congress should consider a higher market threshold. Why would a higher threshold be more appropriate? And what concerns do you have with the $500 million threshold as proposed in this bill?
The real risk that you're worried about here is if players have so much of the part of the relevant digital asset that they're able to move the price themselves. Obviously, when you're donating to charity, you would like the value to be high. So if you can take some market action to increase the price temporarily before donating it, that could help you generate uneconomic charitable deductions. And that's what you're trying to, I think, manage. 500 million could be the right number, but I just think that it's worth further study to make sure that you land in the right place. Some of the pressure on that is relieved if the amendment that requires the sale of the digital assets were to be also adopted, because then you're still leveraging the market for price discovery without having the appraisal issues.
And I know you thought that there should be further study on certain issues. What would be the highest priority study?
Right now, I think that the digital assets tax gap is going to be pretty low for the ones that are traded on custodial accounts and really high for those that are not. And I think that's worth a lot of study.
Thank you. I yield back.
I'd like to inform the members that votes have been called on the House floor. I intend to call a recess following Ms. Tenney's 5 minutes of questioning and to call the committee back to order immediately following the vote series. This time, recognize Ms. Tenney.
Thank you, Mr. Chairman, and thank you to the witnesses for appearing today on this important topic. It's obviously digital assets are no longer a niche corner of the financial system. More than 1 in 5 Americans, we've heard 1 in 8, 1 in 5, but most Americans, it seems, or many Americans now own cryptocurrency, and the total market capitalization of digital assets is, we're estimating, at over $2 trillion. This is a major first step to establish tax certainty and rules of the road for this growing asset class. And as a member of this committee, I know I always think of 4 things: the tax law, rules of the road, and this is a little bit more of an esoteric subject for most of us, but simplicity, transparency, stability, and neutrality, I think, are what we're going to be looking at. I think, Ms. Riley, you mentioned those in some of your testimony. But one of the things I hear from my constituents, not just in New York 24, but all over New York State, is they want to participate somehow in the digital economy. They want to do it safely through familiar vehicles and something they can understand. The same type of exchange-traded products that we know and that we already use for stocks and bonds. But right now, one of the quiet barriers is the uncertainty that is around whether a grant or trust or a structure most crypto ETFs are under can stake held assets without jeopardizing its tax classification. I just heard my colleague on the other side of the aisle mention this. So, Ms. Riley, I loved having you meet with me. It was one of the most informative meetings I had to learn about this this interesting new frontier we're on. I want to follow up on what you talked about in my office, and it's Fidelity has been on the front lines of bringing digital asset products to everyday investors, people I just described. Can you explain what the current tax uncertainty around the grantor trust staking has meant in practice, and how we can fix that? Or let's make it less uncertain.
Thank you, Congresswoman. And yes, I very much appreciated your time. The revenue procedure that came out of Treasury last fall was really instrumental in giving some interim a guidance in this area and remove some of that ambiguity. But even though that's a very helpful safe harbor, only legislation can provide a durable and consistent policy for retail investors. And in the retail space, it's very important that the rules aren't changed, for products that they're holding in their brokerage account. And a revenue procedure can be changed fairly easily in the future. And so having that policy codified is really important to provide that certainty to those retail investors going forward.
So we've been talking a lot about the Tax Clarity for Mining and Staking Act recently that codifies recent IRS guidance allowing, you just mentioned, the grantor trusts to receive staking rewards without losing their tax classification. Does that provision resolve the ambiguity you just described, and how will this translate into yield growth for ordinary Americans? And much like what Ms. Chu raised, is there a concern that we should have with that?
The language in the proposed bill does not only codify the safe harbor that Treasury, but it also removes a suboptimal distribution requirement and also provides some flexibility for managing the liquidity to meet redemptions, which is very important for any exchange traded product. When you purchase one, you expect that you should be able to redeem that whenever you want and not when they have the assets available to meet those requirements. And one thing just to reiterate with the grantor trusts, these basically allow investors to have the same result as if they directly own the asset without having to have a digital asset wallet. They can hold it in their brokerage account, and it's subject to a number of regulations on the security side too, and provides them some safety on that end as well.
So let's stay on the retail investor theme. So let me ask you, for many Americans holding after the ETF holding digital assets, how about through their IRA? How is that affected? And this is a question I want to ask: is how is that going to happen on the same level with the IRA?
The question of,
I mean, does it protect their tax exposure with an IRA?
Yes. The ambiguity persists there to what's subject to unrelated business taxable income. And things like passive investment income are typically carved out. And even though staking is permitted in grantor trust, and grantor trust cannot engage in business activity, which suggests that this income is passive in nature, because it's not expressly carved out under those rules, there's lingering tax uncertainty there, which is could essentially deprive people that are having, investments in proof of stake cryptocurrency in their IRAs from a lot of the value proposition of participating in proof of stake networks.
So we have to look to Treasury for guidance.
Or legislation.
Or legislation. Thank you so much. My time's expired. I yield back.
As announced, the committee stands in recess until immediately following the vote series.
Recognize Mr. Moore for 5 minutes.
Thank you, Chairman. Thank you to our witnesses. This is incredibly important conversation to be having that needs clarity, needs an ability for us to suss out this, and so your expertise has been very helpful today. The Charitable Deductions for Digital Assets Donations Act simplifies the process around charitable donations of digital assets while also providing parity between digital assets and other financial instruments with similar characteristics. As we know, the process around receiving a qualified appraisal before claiming a charitable deduction can be timely, costly, and confusing, of course, for taxpayers, even if the value is readily available. That's why the bill requires digital assets to meet certain requirements in order to avoid qualified appraisal requirement, thereby protecting charitable organizations from so-called sort of pump and dump schemes. Mr. Slotkin, do you think the language included in the Charitable Deductions for Digital Assets Donations Act adequately protects against these types of pump and dump schemes?
Thank you for the question, Congressman. I absolutely do. I think it's a very good attempt at resolving the issue of pump and dump and providing simplification. So what it does is essentially creates equivalence and parity with financial services where there's already an exception for publicly traded stock. So there's an equivalent definition for widely traded digital assets with lots of protections built in to ensure that we're dealing with assets that have readily ascertainable values. So for example, on the Coinbase exchange, we have price discovery, wide trading, people cannot manipulate. That's essentially impossible to do. So it basically ensures with those protections that charities are receiving rightfully what they were supposed to receive, and that taxpayers can't abuse the system in of itself. So it's parity, it's equivalence, and it's simplification, all rolled into one.
Any hangups or snags that might come with this? I mean, you as you talk about it, it seems pretty straightforward, and but anything that you could see impeding us to be able to accomplish something like this?
So there's been some debate over what's defined as market capitalization. In other words, the amount of the token and whether it should be, with the proposal in the bill, I think is rightfully 500 million. There's been a proposal to expand that to 10 billion. And I think we can agree or disagree about that number, about market cap. I think the real question is, do you have a market, and is it manipulable? And I think the current proposal achieves that objective because it essentially discerns what is readily tradable. And by virtue of being a widely traded digital asset, the definition coherently provides the protections that we need.
Excellent. Seems clear enough in a very unclear space, and this is why we need to kind of hash these out. Thank you. Mr. Somansato, we have heard about a recent tax court case. Are you familiar with that case?
Yes, mildly, I guess I will say.
Yeah. What are your thoughts on the Paschal case and the legal certainty around staking? Has it been fairly described here?
I guess whether it's been fairly described, it would be more, the position I would take is I don't think Congress should be relying on a single tax court case to come to this determination on this difficult issue. My understanding of the case was a pro se litigant who was dealing on stipulated facts with the other side, and that the judge even lamented the lack of expert testimony on some of these topics. And moreover, the staking that was involved there involved a centralized institution between the taxpayer and the protocol here. And so there's like a lot of questions that a very straightforward, hey, the tax court found that staking rewards are income. I don't think you can take that legal certainty away from one such decision with kind of all of those factors at play.
Excellent. Thank you so much. Appreciate it. And I yield back, Chairman.
Ms. Moore.
Thank you, Mr. Chair. Mr. Chairman, I've heard about clarity and parity and charity and validators and regulators. And I guess someday we're going to get this right. Mr. Kershaw, can I start with you? You opened up your testimony earlier today by saying that our taxation system was built to really accommodate any sort of new products, new economic activity, the latest and greatest thing. So why do you suspect that we're having such a difficult time inserting this new industry into the current system? For example, I've heard people talking about trading. Isn't that something that the SEC would do? We already have an institution that does that. Say, for example, the CFTC were still stood up the way it was supposed to. Or why do we need to redo everything? You said we could push all this stuff into our existing system. I just want you to expand on that a little bit.
Yeah, I think that the tax system, just by its own nature, applies already to digital assets. And some of the answers might be answers that you want to like tweak or revise for a variety of reasons. So we've talked about extending anti-abuse rules from financial from other financial spaces over to digital assets, but also there's some things that are taxpayer favorable that are appropriate, right? So fixing some of these issues with charitable valuations, that's a great example, and that could use some work. Some of the stuff on mark-to-market seems like perfectly appropriate, but sometimes those rules are like drafted in the code so that they're specifically related to certain asset types, and they just don't today cover digital assets. So I think that those are like.
Oh, what kind of asset is this? I mean, is it a commodity? I mean, is it property? Is it, what is it? I mean, I hate the example of buying a cup of coffee with a Bitcoin, but I keep hearing people say it. So people don't even buy a cup of coffee with a credit card. I don't know, sounds like you have. So can you just tell me, let me ask this question. I heard you say that 1 in 8 people own some kind of cryptocurrency. What's the distribution of people who own these assets? Is it me giving my granddaughter a Bitcoin when she graduates from high school and she's an owner? What's the distribution of the owners of these assets?
I wonder if one of my panelists is a better one to answer that question. They have better data.
Do you know the distribution of people?
I think we started, thank you again, Ms. Moore, for the question. I think you'd be astonished at how democratic crypto actually is.
Okay.
It actually has enormous potential to reach the underserved and the underbanked.
I heard you say that too.
Yes.
So the underserved person who owns Bitcoin, are they staking it or are they just owning it?
It may not be just people who stake assets. Again, I draw back to the use of stablecoins, which are probably the most efficient mechanism. Just internet accounts. Having an account on Coinbase, I can transfer value to you without using a bank intermediary. Many of our population, many of our constituents don't have access to banks because they're for a variety of reasons. But I just think the enormous potential of this technology is, in its most powerful form, is that it basically reaches just about everyone. So you can't, it doesn't just fit every asset class, or like it's not just one. That's part of the problem, actually. So I think you rightfully stated, what is it? So right now, the IRS essentially has told us only one thing about crypto, and that it's property. It has not said whether it's a security, it's a commodity, it's a currency. So we don't have the definitions and clarity, I hate to use that word again, that I think you've called for and rightfully have pointed out.
Okay, thank you. If the goal is to facilitate everyday payments, these lower income people who own this crypto, why shouldn't relief be limited to regulated payment stablecoins rather than extending benefits to speculative assets that are primarily held for investment, so as to make a distinction?
If I may, the definition of stablecoin includes stablecoins that this Congress regulated under the Genius Act. So I agree with you that stablecoins themselves can have various parameters, but those stablecoins that are designed to be essentially traded at par, $1 for $1, those are the payment stablecoins that we're talking about, and those are regulated, and they were essentially regulated by an act that this Congress intelligently decided to pass last year.
Thank you. My time has expired. I yield back.
Mr. Fitzpatrick.
Thank you, Chairman Smith, for holding this hearing. Thank you to all of our witnesses for being here. As digital assets continue to evolve and become more integrated into our broader financial system, it is increasingly important that the tax code keeps pace with these developments. Effective tax administration relies on clear, objective standards that taxpayers can readily understand and that the IRS can apply consistently in practice. Without precise definitions and workable rules, rapidly changing asset structures can create uncertainty, increase compliance burdens, and lead to inconsistent treatment across similarly situated taxpayers across our country. Under current law, as you all are well aware, the only definition of digital asset appears in section 6045 of the code. The definition included in that section is very broad, and it does not distinguish between different types of digital assets and the ways in which they are used by taxpayers. Obviously, this can create confusion for taxpayers who use digital assets and makes it hard to identify how certain transactions involving digital assets should be treated from the taxpayer's perspective. This series of legislation, as has been described by my colleagues, aims to distinguish between different types of digital assets in the code, defining terms like traded digital asset, widely traded digital asset, and tokenized assets. Ms. Riley, do you believe distinguishing between digital assets in this way is effective with the end goal of clarification and certainty for the U.S. taxpayer?
Thank you for the question, Congressman. As you know, a part of the challenge of legislating on digital assets is that digital assets can have a variety of use cases. They can be used for investments, governance, payments, and business activities. If you're going to make policy decisions to treat assets differently in different contexts, it's very important to have clear defined rules to bucket those assets. Definitions like traded digital asset and widely traded digital asset provide clear lines to help distinguish when assets are more like analogs in the tax code, such as securities and commodities that are highly traded assets with established markets. And so this provides clarity on those categorizations.
And zooming in on the tokenized asset definition, here it would apply to any digital asset in which more than an insignificant portion of its value is tied to the underlying asset, right, or interest rather than the operation of the blockchain in which it is recorded. Again, to you, Ms. Riley, as it relates to this definition of tokenized asset, is it your belief that there are other considerations that should be made here?
Just to note, I think under general tax principles, we generally consider tokenized assets to be treated consistently with the non-tokenized version for tax purposes. But having a definition like this is very helpful, especially in an area where we've had a lot of ambiguity. So this clarification is appreciated. The definition of tokenized digital assets specifically refers to, as you know, assets that derive much of their value from something other than the blockchain. So we're talking about real world assets. And I think this definition captures that nicely, where it's referring to whether it's securities or something else, that distinguishing that from a digital asset that its value is on the blockchain.
Thank you, Ms. Riley. I yield back, Mr. Chairman.
Mr. Feenstra.
Thank you, Chairman Smith, for holding this hearing today. And I just want to thank each of our witnesses. I want to tell you, you are the experts in the field. And it's exciting to hear and read your testimony. I'm actually really excited. I'm excited about the opportunity of what we have as a country going down these paths. I fully understand that we have a lot of uncertainty. And that's what we're trying to do today. We're trying to create an opportunity to create certainty and guardrails that we can create capital growth in our country. As we see, with uncertainty creates this area where people go offshore because they don't know how to handle all the things that we're doing. And we have an archaic system, and we're going to change that with the 7 bills that are out there that we're hoping to mark up. In Iowa, all right, I'm a farm kid. In Iowa, our farmers understand the idea of creating value by recognizing income. When a farmer plants corn, we don't tax them the day the corn comes out of the ground. We tax them when they actually sell their crop as realized income. Right now, digital asset miners and stakers can face taxes when they receive a newly credited digital asset, even before they have sold it or realized the value of the asset. Okay, that's wrong. Congress, we have the responsibility to make sure our tax code keeps up with innovation like this while applying common sense principles that have worked for our industry over the decades when it comes to agriculture and many other things. Ms. Riley, thanks for being here. I would love to ask you about your company and how things are going and moving forward with this, because this is all new to you too, I'm sure, over the last decade. But can you explain why this legislation strikes the right balance to create a more consistent tax framework while ensure costs for these ordinary assets are properly accounted for through capitalization? I know you went through this shortly, but I want to hear it again.
Thank you for the question, Congressman. And I think one thing that we're really looking for in this legislation is clarity on, the timing, character, and source of staking and mining and other validation rewards. And this legislation certainly addresses that. And I think it's also an acknowledgement of the reasonable arguments on both sides regarding the timing and how that should be treated under the tax code. And allowing for taxpayer activities seems like an appropriate solution, especially given that there are pros and cons to the individual taxpayer as to whether that would actually be beneficial to them.
Yeah, I agree. I mean, it gives them some certainty. They now will know how it's going to be taxed. I mean, it creates some forward-looking of, especially in your organization, of what they can account for, correct?
Absolutely. And that's one of our goals in seeking legislation is we want to be able to report things accurately to our clients so that they can report things accurately on their tax returns. And this definitely provides clarity on those points.
Yep. Mr. Salmoncedo, I want to ask you sort of the same question. Obviously, compliance and complexity, it just seems like we're so deep in the weeds on paperwork right now, especially when it comes to 1099s under $10 and all this stuff. Could you explain how the legislation before us establishes clarity in transaction using digital assets and accounting for gain or loss so Americans can confidently participate in digital asset economy?
Yes, I think there's a few important ways that the bills do that. One that we've talked about a decent amount is the idea of excluding gains from the stablecoin calculations and from the gas payments, which is really important. I think perhaps more interestingly is the simplified accounting methods that are also included in that same bill, which basically take on the recognition that people are making numerous transactions with these, whether they look like payments, whether they look like trades or buying something like an NFT, and trying to come up with a system whereby we can simplify that for the individual taxpayer, and doing that through basically understanding, their total gains throughout the year and crediting, certain dispositions and sales throughout. Creates a system that would make it much easier on the average individual to be able to take on the task of trying to figure out what the tax liability looks like for so many transactions.
I think more people will engage.
Right.
I mean, and right now the system is so complex that a lot of people don't engage. They don't understand it. They're worried about it. And I think these bills will help that. So I'm excited. I mean, it'll create capital growth in our country and not seeing it go overseas. So thank you again for each one of your thoughts and your witness testimony. Thank you. I yield back.
Mr. Swazi.
Thank you, Mr. Chairman. Thank you to the witnesses for all the time you spent here today. People have been in and out of these hearings all day because we've had so many things going on here in Capitol Hill. And I'm a pretty well-educated person. I'm trained as a lawyer and a CPA. I'm a member of the United States Congress on the Ways and Means Committee, and I really don't understand cryptocurrency that well. And I think that I speak for many American people that they really don't understand cryptocurrency that well. But we're today talking about what kind of tax policy can we establish here in our country, because we have a couple goals. Number one is cryptocurrency is not going away. So if it's going to succeed in the world, we'd like America to be at the forefront of that success. And clear tax policy will be an important part of making sure that America does remain successful. Another concern of the American people is that they're concerned that because they don't understand this and that cryptocurrency is decentralized, it's harder to track. And they're worried about illicit transactions taking place utilizing cryptocurrency as opposed to the traditional currency and banking methods. So I just want to ask you guys a couple different questions. Can you first, one of you, maybe you, Mr. Katcher, tell me the difference between meme coin, stablecoin, and Bitcoin? And you have to make it very brief because I only have a few minutes.
A stablecoin is the place to start. It feels the most of the bunch like a fiat currency in the sense that it is supposed
And
to.
by a fiat currency, you mean?
Like the US dollar, like a government issued currency in the sense that it is meant to track and be pegged to the dollar. Bitcoin is, I would say, more like a different kind of asset. It can rise or lower in value.
More like an equity?
More like an equity. Some people say gold, but those are probably the two most common parallels that I hear. A meme coin is neither of those things. It's more like a meme stock, right? A sort of an asset class where there's nothing inherent to the value at all. That is.
Would you say that any one of those three types of cryptocurrency are more attractive than the others?
I think that the one that's the most attractive in terms of potential like use for the things that people talk about buying stuff, stable coins seem like they have the most promise.
What about you, Mr. Samasanto? Would you say that one of those is more attractive than the others?
I think attractive in terms of use cases for a blockchain network.
What's good for America and good for our economy of those three? Or are they all good?
I guess I leave it up to the individuals who are using these assets to define
That's
what's
leadership,
good for them.
Mr. Samasanto. Okay, Mr. Zlatkin, what would you say?
I think they're all valuable, and I think they all serve their purpose, and that's one of the great aspects about the crypto industry.
What
that
purpose
has
does
lots
the
of
meme
variation.
coin serve? What purpose does the meme coin serve?
At the same purpose that any social network has. People like to create things. They like to create music, so they create meme coins.
I mean, there's
So-
wild fluctuations in the value of meme coin. They go way up and they go way down. People lose their shirts when they try to invest in them. There's no intrinsic value, as Mr. Karcher said. So you would say that's of equal value as a stable coin as far as what's good for our economy?
Again, I'm not passing judgment. I'm just saying there's a varied number of tokens.
How about you, Ms. Riley? Do you feel any of these, one of these three are better than the others, or they're all equal in your mind?
Well, I think it really depends the context in which you're talking about them. I mean, I think you could also argue that trading cards have no intrinsic value, but they have value to the people that want to trade in them. So I think something like meme.
So we don't really have much of a tax structure or policy regarding trading cards, would you say?
I think we're less concerned about the trading of meme coins and more things like stablecoin that are used as, mediums of exchange for payments and everyday transactions. Bitcoin is also, given, how many people own Bitcoin, it is used in transactions, it's used for investment.
So but what about meme coin? Would you say that's used for investment or for transactions?
I don't believe we have a very strong view on meme coins.
Okay. Okay, very quickly, I've only got 50 seconds left, 10 seconds. If you could just tell me the major benefit of cryptocurrency, Mr. Karcher?
It's a free market and people should invest in the stuff that they think is useful to invest in. That's part of the fiber of America.
Mr. Samasanto?
The ability to send assets in a peer-to-peer fashion without an intermediary to censor those transactions.
Mr. Zlatkin?
It leverages the use of the blockchain technology for the financial economy. So it democratizes it and gives us access to a more efficient system for running the financial economy.
So moves things more quickly also. So if you want to do a stock trade with cryptocurrency, it would clear faster. Is that true?
It clears instantly. It clears as quickly as an email.
Ms. Riley?
So just to build on that, I mean, I think the speed, the security, and the reduced costs are all key parts of what makes it valuable for the financial system.
Well, I really appreciate all of your time here today. Thank you so much for spending so much time with us. It's a very difficult concept for many Americans to figure this out, and we appreciate your expertise in helping to educate us. Thank you so much.
Mr. Carey.
Thank you, Mr. Chairman. I also want to thank the ranking member for this very important committee meeting discussing bipartisan issues regarding digital assets. Last April, and some of you already know this committee produced the first digital assets related legislation that was ever signed by a United States president. And this was the DeFi broker rule, CRA. Now, when we had the bill in this committee, we ultimately, when it went to the floor, it passed out of this committee, ultimately went to the floor. We had 76 Democrats that voted with us on this rule. Unfortunately, 6 of them were on this committee, were my colleagues on the other side. Now, they didn't vote for it in committee, but ultimately were part of the 76 that voted for it. So I think in the end, the explanations and the questions that we have today, once you see everything that has to do within the context of these bills, you'll see that these are really good pieces of legislation. One area that I'm particularly interested in, obviously I'm carrying it, which is the Clarified Mining Staking Act, but I just want to kind of maybe focus on that a little bit. So, Mr. Samansano, can you very, very briefly explain, and I think this is important, and my colleague just asked you to kind of clearly say what is good and what is bad. But if you could just explain these terms, okay, for not just members of this committee, but people that may be watching, explain mining and staking to those people that may be unfamiliar with what those terms actually mean.
So I think the way I'll start at that is to talk about what process these players play in these ecosystems. Most importantly, what they are doing is validating the transactions. The way that these networks work without a central intermediary sitting there in the middle with a ledger where they're keeping track of all the transactions is you need all of the participants to agree on what the canonical transactions are. So a staker and a miner are doing somewhat the same thing. They are reviewing the transactions and saying, this is a valid group of transactions, and I can prove that, and I am putting something at stake. In the sake of mining, what you're putting at stake is your energy. You are using compute energy to solve a complicated puzzle, to basically be selected to play this validation role. Similarly, for a staker, you are putting your assets at stake and saying, I will do this in a trustworthy manner, or my assets will be taken away. But either way, the process of staking and mining is simply validating those transactions. And the really unique thing that goes on here is the protocol allows you to create new assets. That is the incentive mechanism for people to participate as validators, as stakers or miners, is this ability to create the new assets if you play this important role in the network.
Okay, I think those were good explanations. If we can get it at a quicker step, it might be helpful for a lot of folks. But Ms. Riley, I'm going to go to you real quick. The legislation that we are discussing today allows the taxpayers to make a choice between two prevailing theories about how mining and staking rewards should actually be taxed. Either newly minted digital assets are included as ordinary income upon receipt and held as capital asset thereafter, or taxpayers can elect to treat newly minted digital assets like self-created inventory and recognize ordinary income upon distribution. So is this the appropriate approach from a tax perspective, in your opinion? Or why or why not?
Thank you, Congressman, and thank you for your leadership and introduction of the Tax Clarity for Mining and Staking Act. I think that there are reasonable arguments on both sides of the equation here, and the option of having taxpayer electivity seems like an appropriate way to balance. There are pros and cons from a taxpayer perspective in terms of which is beneficial in terms of timing, whether taking it into income immediately and having any appreciation get capital gain treatment versus deferring recognition and having all appreciation be ordinary. So it is not an immediately, preferential treatment for such assets, and this seems like a fair way to balance those differing arguments.
Okay, Mr. Zalkin, I was going to ask you the same question, but I'm running out of time, so we will get this for the record. As you can see, I mean, this is an issue that you have to kind of learn to walk before you can run type of thing. And I do think you'll find many members of this committee are committed to getting to that process on both sides of the aisle. Again, you saw it in the DeFi broker rule. I think you're going to see it with this tax package as we move to the floor. So with that, Mr. Chairman, thank you again. And to the witnesses, thank you for being here. With that, I yield.
Mr. Miller.
Thank you, Mr. Chairman. Truly appreciate it. And I appreciate the committee's continued focus on digital asset taxation and the need to provide taxpayers with greater certainty throughout this process. For too long, taxpayers have been forced to navigate a patchwork of framework and guidance, administrative interpretations, and unanswered questions. Congress has a responsibility to establish clear statutory rules that promote compliance, support innovation, and preserve the integrity of our tax system. I think it's important to recognize that many of the concepts reflected in these bills were developed over nearly 2 years of bipartisan work, with Congressman Horsford and I spent considerable time engaging with stakeholders, practitioners, academics, and industry participants to develop the Digital Asset Parity Act, a comprehensive framework designed to address these issues in a coordinated manner. That framework was built around a simple premise. Digital asset tax policy should be coherent, administrable, and technologically neutral. The challenge before us is that digital taxation is not a collection of isolated issues. Mining interacts with staking, Basis rules affect reporting. Anti-abuse provisions affect compliance and investment decisions. Changes to one area can have consequences in another. As we consider these proposals, I hope we remain focused not only on whether individual bills will solve discrete problems, but also whether they will fit together as a part of a durable, comprehensive framework. In some cases, I'm concerned that modifications to previously developed concepts may inadvertently create new complexity or undermine the policy objectives they were originally to achieve. Today's hearing is an important opportunity to examine those questions, understand the interactions among these proposals, and ensure we get the policy right, because I believe now is the opportune time in order to move this forward for framework. So, Ms. Riley, it's good to see you again. Thank you for being here. We know that digital asset provisions often interact with one another in ways that aren't immediately apparent when legislation is considered separately. For example, basis simplification rules may operate differently for taxpayers who are subject to or elect into a mark-to-market regime. If Congress were to create a deemed basis regime while separately considering mark-to-market treatment, are there circumstances where the interaction between those provisions could create unintended consequences or unnecessary complexity?
Thank you, Congressman, for the question. I think I might need to give that one a bit more thought in terms of how those would potentially interact. But I think that is a valid concern about how code sections can have unintended consequences.
Yeah, thank you very much. As I said before, and I'm very supportive of the process and the chairman behind me and what we're moving forward with and doing, I just want to make sure that, once we get this right, that we truly get it right and that we can continue to evolve off of it and not hopefully, mess it up in the way. Mr. Slotkin, good to see you again as well. When stakeholders evaluate digital asset tax proposals, do they generally view issues such as staking, mining, basis reporting, and mark-to-market treatment as separate policy questions or as components of a broader tax framework?
I think most people probably don't think about tax policy the way you do, and I want to applaud both your efforts and Mr. Horsford's efforts in bringing us to where we are, because you've really sort of blazed the trail. I think what you've accomplished and what taxpayers should think about is that we're developing a comprehensive framework for tokenization and essentially the financialization of the blockchain, and it's a broad array of both industries, assets, and activities. And I think to the extent that, and this series of bills actually ambitiously tries to address that. It tries to simplify it, it tries to clarify it, it provides clear rules for the road, and I applaud all those efforts.
Thank you very much. And for the reason is to move forward, and I know there are some colleagues on both sides of the aisle that are uncomfortable with cryptocurrency, and they truly, don't understand it, or they just don't get it. I can tell you in the state of Ohio, every 1 in every 5 Ohioans owns a form of cryptocurrency. So these are the individuals, these are everyday Americans, and we have to bring stability to the tax code. And my biggest concern is if we do not, people will not come to the United States of America, to the crypto, capital of the world, as President Trump wants us to be. They're going to continue to go to other countries and operate out of there because they will have a stable tax code that they can operate out of that won't be in a phantom tax. So I greatly appreciate all of our witnesses here today. Thank you for all of your hard work when it comes to pushing this forward. And I really do hope that we can get this in a good place to see through the finish line. But thank you, Chairman. I yield back.
The gentleman yields. The chair now recognizes Mr. Snyder for 5 minutes.
Thank you, Mr. Chairman, and I want to thank the witnesses for your patience and stamina as you're here today. I'm glad we're having this hearing to talk about a very important issue and explore ways that we can address some of the gaps in our tax code to better adapt to digital assets. As my friend Mr. Carey noted, it's a complex issue, and I believe we need to understand the many facets of the issue, as he noted, in the matter of crawl, walk, run. Mr. Miller, who just spoke, noted that we should act, we should evaluate, we should evolve over time. This is not going to be a one and done solution, I think. Most important thing I want to reiterate is that we need to work at this, address this in a bipartisan way. We should be working across the aisle. I believe and experience shows that when we work together to reach across the aisle and craft solutions, we can create policies that stand the test of time. And being perfectly honest, that's why I'm disappointed that we're here today discussing a number of partisan bills that were dropped at the 11th hour when the committee has a
bipartisan proposal already drafted that they're choosing to ignore. I think it's unfortunate that the majority would rather draft their own bill behind closed doors than find true bipartisan consensus working with everyone on this committee. I know members on both sides there want to work on the best solution here, and I know that they know that the only chance for a durable solution is if we work together. Representatives Horsford and Miller have been working diligently for over a year to craft a sensible bipartisan solution. That's the proposal that we should be considering at this hearing today. The bipartisan path forward is the only way we can ensure the changes we make to the tax code are durable. And when it comes to changing the tax code, durability should be one of our top priorities to give certainty and clarity as people plan for the future. We should be focused on making improvements to address some of the outstanding questions for adapting the tax code for digital assets that make sense and clear barriers for people in this space. We should be focused on providing clarity to taxpayers and to companies so everyone knows what is expected of them and what they can expect when it comes time to file. And the industry is able to grow, as Mr. Miller said, here in the United States. We should be focused on reducing or streamlining unnecessarily burdensome paperwork where it makes sense. We should be focused on providing parity where it makes sense too, and put up guardrails to prevent abuse without curtailing digital assets entirely. We can thread this needle. We can find common ground on how to best address these issues if we are targeted and if we work together across the aisle. And I wish that's what we were doing today in this hearing, looking at a bipartisan proposal. With my little bit of time left, let me turn to you, Mr. Kircher. You've spoken about some of the concerns in this proposal. What, in your view, in these proposed bills or what might be left out, what concerns you most? What haven't we touched today that we need to? What should we be focused on as we walk away today, considering our next steps?
I think given the mobile nature of the assets and the risk of tax noncompliance when you don't have good information reporting and the attendant concerns about money laundering, illicit finance, and other nefarious activities, including drug trafficking, the real focus or a good use of focus would be trying to solve that problem through whether it be tax reporting or additional AML, KYC type rules, but really closing the remaining digital tax gap and also reducing the risks of illicit finance and other nefarious activities. That would be a really good use of the members' time.
You know, I appreciate that. You know, my concern is if we let the nefarious activities consume us, if it rises to the crisis or it's what's on the front pages of the news, it takes us away from focusing on the policies that will move us forward in a positive way. I'm going to do something unusual. I know the hour is late and everyone's probably tired. I'm going to yield back almost a minute of my time. I yield back.
The gentleman yields. I now recognize myself for 5 minutes. Thank you to our witnesses for being here today. In 2025, digital asset market capitalization totaled $3 trillion. These estimates show up to 30% of American adults own digital assets. Under the current tax code, digital asset users face high administrative burdens and opaque guidelines. Additionally, anti-abuse rules that apply to traditional finance assets do not clearly apply to digital assets. That creates opportunities for misuse. This committee has spent the last year working with various parts of the digital asset industry to understand the unique challenges consumers face in the existing digital asset tax structure. As conversations around the treatment of digital assets used in everyday commerce progressed, it became clear that a stablecoin-only approach would not suffice. I'm proud to lead the Less Tax Paperwork for Digital Asset Owners Act, which includes the option for taxpayers to select a simplified accounting method for one or more widely traded digital assets. This is a common sense change to streamline the reporting process and alleviate unnecessary administrative burden. This simplified accounting method ends the requirement for filing a Form 1099-DA for every single digital asset transaction. Mr. Somensato, Coin Center has argued for years that everyday crypto holders shouldn't have to track the basis of every fraction of a coin across hundreds of transactions. Instead, they should be able to just pay tax on the net change in value over the course of the year. How do you think the simplifying method will affect taxpayers?
I think conceptually it offers a a really valuable option in terms of simplifying the process by which an everyday crypto user can, simplify their tax payments. I think that I want to spend more time to just kind of make sure I understand like exactly how it would work in practice. One thing I would point out for your consideration is perhaps that the treating all of the gains as short-term capital gains might be a touch too punitive. For comparison's sakes, you could invest in a Bitcoin perpetual future right now that trades on a CFTC regulated exchange, and the code would treat that as 60% long-term gains and 40% short-term. And those are essentially, from a price exposure perspective, equivalent assets as tracking the price of Bitcoin in a financial instrument versus actually just holding Bitcoin, for example. But otherwise, going back to your original point, I think it's really important to think of these solutions, which I think are frankly creative, right? This is something that might be a unique offering in the crypto ecosystem, but one that ensures that the individual can continue to participate in the way that we think that they should be able to.
Because wouldn't you imagine if you didn't have to calculate the gain or loss on, let's say, a $2 transaction, you don't have to calculate gain or loss on the basis of that $2 equivalent in digital assets, it would be much simpler and easier to use?
Yeah, I definitely do. And I think that would be ultimately the interesting decision would be to see how taxpayers engage with that, to see to what extent they would be taking on that election. But I think, at least anecdotally, my experience is that simplicity is kind of what most taxpayers are looking for in this area.
Thank you. Mr. Kirscher, you and the Tax Law Center have advocated for an alternative method of accounting, such as mark-to-market, as a solution for administratability concerns in lieu of broader de minimis proposals. Do you see this simplified approach, simplified accounting method, as consistent with your recommendation?
In concept, it's absolutely consistent and has the potential to reduce administrative burdens while not providing new kind of other integrity-based issues in the code. I think the devil's in the details, and so you need to study it pretty closely and making sure you're getting the details right. But in concept, it's pretty potentially a positive idea.
Thank you. The bills we're considering today make meaningful changes to provide clarity to consumers, to businesses, and to other stakeholders that work with digital assets. Creating more clarity defined in a defined tax structure will lead to reduced administrative burden as well as better compliance. That's essential to fostering innovation and allowing digital assets to thrive in the United States and not force them abroad. Thank you all again for being here today, and I yield back. I now recognize Mr. Byer for 5 minutes.
Mr. Chairman, thank you very much, and Ranking Member. And thank you all for staying until the very bitter end. You'll discover the halls are empty when you walk inside the door. Mr. Kircher, in your analysis of the Less Tax Paperwork for Digital Asset Owners Act, you discussed the challenges the IRS is going to have in the proposed mark-to-market regime for non-stable coin digital assets. And you mentioned that the IRS has lost about a quarter of its staff, 3/4 of its leadership in the last year and a half. We have had the acting director in here a number of times, pushing him pretty hard, just about the depleted capacity to write timely guidance and carry out the enforcement function. So just general, if they don't reverse the cuts to the IRS, what would you expect the results to be? How much trouble is the IRS going to have implementing the proposals? Could we see more evasion and abuse as a result?
I think without proper funding, it makes it harder for Treasury and the IRS to implement any new law. And that's a combination of the guidance, but also the systems necessary to implement simplified reporting and other kinds of things. Absolutely, on the enforcement side, with reduced resources, you'll almost certainly see reduced revenue as well. My first job at the IRS, I was working on the Foreign Account Tax Compliance Act, and that was a bipartisan bill that came with implementation money on a bipartisan basis. So that's something that could be appropriate and worth study.
Should we consider asking the GAO to look into the capacity of the IRS and their recommendations?
GAO or TIGTA, I think, would be very appropriate to ask those kinds of questions too. I mean, there is a question of where sort of the breaking point is and what is and isn't possible on a reasonable time frame, and what the trade-offs and risks are of trying to move something without having the resources there to actually do it.
Thank you. And Ms. Riley, first of all, thank you. When I signed on to the No Stock Trading Act 4 years ago, I had to sell the stock I had. This fidelity was there. to give us that cover and a good place to invest too. The End Digital Asset Tax Shelters Act was intended to curtail the tax dodge what we're seeing the crypto investors in Puerto Rico misusing their Act 60. It's been interesting looking at Representative Velasquez as legislation that would ensure that any sale of digital assets or a stake in a digital asset is treated as U.S. source income, ensuring that all sales of digital assets are taxed at the full U.S. capital gains tax rate. The legislation we had before is slightly different in that it says that it's considered U.S. sourced unless the gain is taxed at a rate of 10% or more in Puerto Rico. We assume that Puerto Rico would modify its tax code to be at least 10%, but there still could be incentive for investors to take advantage of the differential between the new Puerto Rico tax rate and the U.S. capital gains tax rate, which is 20% for long-term at least. What are your impressions about both approaches? Where's the wiser way to go?
Thank you, Congressman, for the question. And I think that is something that we are looking into and thinking about. This is certainly a complex area of law and understanding what the potential implications could be. I do think it's important that we are addressing this, and I think we would need to see, is this preferential in any way as compared to other assets? Because I think the focus is on treating crypto no better and no worse than comparable assets.
Great. Thank you very much. And Mr. Kircher talked a lot about mining and staking, the Tax Clarity for Mining and Staking Act. As you mentioned, this creates a variety of problems. The principle of parity among asset classes, which I confess I know is very complicated just listening today. The administratability challenges, the potential for abuse. And there's also the Joint Committee on Taxation says $3 billion over 10 years, which we're supposed to be the responsible ones here fiscally. My colleagues, Mr. Horsford and Mr. Miller, have a different approach in their Parity Act and then in the amendment before us today, which allowed deferral for up to 5 years rather than 10 years. But there's even concern about that. Did you notice that every time we get close to the 5 years being up, the excellent lobbyists come in and convince us to kick the can down the road? We saw with the TCJA, we've seen that the OBBBA. What's your concern about whether Mr. Horsford's bill, which I very much support, with 5 years, that the 5 years would actually be 5 years?
There's obviously the political question that you're describing of whether it actually stays and lands for 5 years. I think there are ways to make relatively small modifications to that bill to make that kind of irrelevant. You could do an interest charge or something to provide full parity. I think that the Digital Parity Act is very close to full parity today, but if you added an interest charge, it would probably be true economic parity, and that puts less pressure on that question.
Great. Thank you very much. My time's up, and I yield back. Thank you.
The gentleman yields. The chairman now recognizes Mr. Horsford for 5 minutes.
Thank the chairman for yielding, and it's been a good, productive afternoon. And first, we've heard broad agreement throughout today that taxpayers deserve clarity. The question is not whether we modernize the tax code. The question is whether modernization is grounded in parity, fairness, and economic reality. We should fix genuine compliance challenges. We should also support innovation. And I believe that we can do both of those things while not creating a tax advantage that is unavailable to certain taxpayers, other investments, or other forms of income. Congress should reward innovation, not tax arbitrage. For the past year, Representative Miller and myself, as well as our dedicated staff, have been publicly working on digital asset taxation legislation. There are 3 principles that grounded our work and will be my focus of my questions today. First is on digital assets. They should have parity with existing financial instruments. Where there is uncertainty, we need to address that. Second, we need to solve for the problem, solving that problem should not create another problem. We cannot create special tax loopholes. And third, we must ensure that any benefits reflect economic reality. For this package to stand the test of time, it must be fair, administrable, and resistant to abuse.
I want to thank Chairman Smith for adding my amendment that includes those changes that I've been advocating for. And let me be clear, the changes that I'm asking for have been publicly vetted and socialized with stakeholders. These are the minimum to get my support for this package. But there are still more changes that must be done to get this policy right, and several of you have identified some today. As the chairman has said, we are on the 1 yard line, and if we want to meaningfully do this together, we have to work together to accomplish that. But let me start with validation rewards. Under current law, when someone receives a validation reward and can use it, sell it, or control it, they generally owe tax on it at that point. Is that correct? Yes or no? All the panelists. Very quickly.
Yes.
I would disagree that the law as applied is correct right now.
I think it's unclear, and therefore I think your attempt to try and achieve balance with that by having an election is a sensible one.
I agree with Mr. Zlotkin's explanation.
Thank you. For the past year, I've heard concerns about people owing tax before they have practical access to cash from those rewards to pay the tax. Some have referred to this as a phantom tax. I think that is a fair concern. The question is how Congress addresses that concern without creating a new loophole. Yes or no, is phantom income and liquidity concern a major issue that Congress needs to address when it comes to validation rewards?
Congressman, I agree with that. I think it is an issue. I think liquidity is an issue and a major reason why I endorse some of the proposals that you've come up with. Thank you.
And Congressman, I believe that there are issues in determining when there is appropriate dominion control, and it presents challenges about when this should be taken into income. And it does present issues of liquidity and being able to meet one's tax burden.
Mr. Karcher, can Congress address the liquidity concern without creating a system where someone can delay paying taxes indefinitely?
Yes, I think that sort of short time limited deferral can address liquidity without permanent or indefinite deferral. That's certainly the case. That would still be a little bit different than the normal current treatment, but if your focus was liquidity, that would be your tool.
And if Congress created that kind of unlimited deferral rule here, would that be more favorable tax treatment than what most workers receive on wages or what ordinary investors receive in a 401k, for example?
It would be definitely more favorable than wages, which are taxed immediately. It would be more favorable than any stock held in a brokerage account, and it would probably be more favorable in many cases than even stocks held in a retirement account, because you wouldn't have the required minimum distribution rules apply.
Very quickly, with the indulgence of the chair, I just want to ask about charitable deductions. I'm not here to oppose charitable giving. I want to make sure that the deduction reflects the real economic value the charity can actually receive. Mr. Karcher, at the end of the day, isn't it the clearest measure of value what a charity is actually able to receive when it sells an asset?
Yes, using the third-party market transaction is the best price discovery we have.
Congress has dealt with valuation disputes for years involving hard-to-value assets, and that's why we need to get that portion right. I'll just close by saying, if Congress does nothing, regulators, courts, and offshore markets will define the rules instead. Inaction is not neutrality. It means uncertainty. It means taxing the system, gaming it, fragmented enforcement, and exploitation by wealthy and sophisticated actors at the expense of everyday consumers. That's what we are working to achieve in the Parity Act, and I hope with the majority's indulgence, we'll be able to get to those larger policy goals so that we get this right. We don't just get it done. Thank you, Mr. Chairman, and I yield back.
The gentleman yields. I would like to thank our witnesses for appearing before the panel today, with the panel. Please be advised that members have 2 weeks to submit written requests and be answered later in writing. Those questions and your answers will be made part of the formal hearing record. With that, the committee stands adjourned. Gavel.
How often do they come down here?
Probably like 3 times a week.
3 times a week?
Hell
To
yeah.
get the ballots?
Yep.
Wow. And so you know other people too that voted too?
Anybody's registered, dog eat dog.
I've been saying this since the beginning of time. I said that I'm never believing that Spencer Pratt had a chance to win in Los Angeles. I don't believe that we'll see a Republican governor or mayor of Los Angeles at any time in the near future, as long as we are not having any standards for what voting is supposed to look like, and the American people are not standing with Trump, at least on this issue. And people have Trump derangement syndrome to the point to where they don't even believe in free and fair elections as long as it does not align with what they believe. And even if it led into somebody becoming a Democratic president of the United States of America, if it came along with it don't going the right way, which is the reason why I don't believe, and I said this on Stephen A. Smith's show, I said it on multiple different platforms, I'm saying it right now. There's no way that you're going to convince me that Joe Biden got more votes than any other president in history. In history. As long as we have these crazy mail-in ballots, as long as we have all of this finesse, and as long as you don't need ID in order to vote, as long as they can go onto the street and start giving people $2 and $4 and $5 in order to vote for who they feel like they can vote for, and the person and the people have no integrity. These are people that are supposed to be public servants. They're supposed to be serving the people and the taxpayers. As long as this exists, I'm off. I'm off. As long as we have mail-in ballots, I'm off. There's no reason people fought and died, especially Black people, part of the civil rights movement. They fought and died for our right to be able to vote, for us to have truly free and fair elections. You have people, Democrats in Congress today, that are against having voter ID in order to vote. Across the board is one of the rare things that I think should be implemented across the United States of America. Right? Because I do think that every state, to an extent, probably 95%, I like the fact that they kicked down abortion from the federal government, and they released them from that burden and allowed for them to be able to vote on it locally so that you can determine whether or not you actually align with it. And Ohio is a very good example, even though it's a red state, right? They voted for them to be able to, and I may disagree with it, but I also believe in our freedoms, right? That is what America is at its core. It's the freedom to be able to pursue life, liberty, and justice. It's the freedom to be able to achieve the American dream if you work hard enough. It's the freedom to know that whatever it is that we as a collective in this republic that is governed by the Constitution, and we have these democratic elections, it's the confidence to know that, you know what, we're probably a lot more upstanding in how we go about doing things, and not having a dictatorship, not having communism, not having socialism, whatever it is, we have the freedom to choose for ourselves. But whenever that is undermined, whenever we have to have these conversations, and you can go right down on Skid Row, right? I've been to Skid Row multiple different times, walked through it the whole time, had different conversations, vlogged it, the whole scenario. Whenever you can go down to Skid Row and talk to people that are telling you that they were paid to vote for Karen Bass. And if you're not going to vote for Karen Bass, then vote for the other chick. But Spencer Pratt don't even have a chance. Yo, it's insane. Spencer Pratt absolutely washed them during the debates. Spencer Pratt absolutely destroyed them during the debates. And all of his ads and all of this stuff, I would just absolutely be defeated. You can't convince me that based off of what we've seen over the last, in this whole pandemic, 2020 through 2024, that y'all are telling me that what y'all lived through, which had crazy inflation, people over in Los Angeles and California, a lot of them had their homes burned down. I go over to Los Angeles and on the West Coast on a regular basis. I prefer to go over to La Jolla, But even if you go down to downtown San Diego, you go to a lot of these places and you're looking around and you're like, wait a minute. It's a tale between two worlds. Business owners can't even open up because people have tent cities all across the blocks, all across the street. I can't even imagine that a business owner could even survive considering what we see over in California and Los Angeles. And now you have proof. And my man over here thinking that he bartering, right? You know what? I'm a barterer. They can offer me $2, $1, but I asked for $4. They're paying homeless people, people on the street, drug addicts, whatever. When I seen Spencer Pratt and he had that whole conversation and he was having it was really an ad, but it was really just the truth. And he had a whole conversation about how California does not have a homeless problem. California doesn't have a homeless problem. They're enabling drug addicts. They're enabling all of this because they want to keep the money rolling in from taxpayers, rolling in from the federal government, continuing to finesse y'all because there's so much fraud. Whenever California actually creates the Nick Shirley Act, you know it's some evil going on inside of these spaces. Evil everywhere. And it's going to take more than just my voice or Nick Shirley's voice or anybody else's voice that want to speak out and have a conversation and expose the system for what it is. And I don't care if you're Democrat. I don't care if you're a Republican. I don't care if you're a liberal or a conservative. I don't care who you are. I think that we should all fairly agree that we cannot have falsehood inside of our elections. We cannot have fraud running rampant throughout our cities. We cannot be having this level of visibility and do nothing about it. But you know why people don't do anything about it is because it doesn't necessarily come straight to their doorstep. If I'm in Los Angeles and I'm a resident, I'm outraged. I did the whole review video of how they were finessing and using the fire money, and a lot of it hasn't even been distributed. All of the donations that came in from people just absolutely disappeared. They redistributed a lot of the different monies that is allocated for one thing, and they do it to shore up the budgets. Leveraging all of these illegal migrants that come into the state for one person's success is insane. Absolutely insane. And we just sitting here like it ain't no big deal. You know what? It's not that bad. You know what? Let's just go ahead and let them rock out. Let's let them do whatever it is that they want to do when they want to do it. And we act like it's not no big deal. We act like it's just cool. Hey, listen, y'all go ahead and do what y'all want to do and let's get it popping. Where they do that at? How we play that out? How is that even a thing? How are we not more vigilant about what happens inside of our democracies and inside of our states and local governments and all of these different things? How are we allowing for nobody outside of this reporter that came out and asked them a question about how much and who they voted for as a result of it? And all of them are saying the same thing. They're corroborating their stories and nobody is tripping about it. And why wouldn't they? Why wouldn't they take the money and they out there in the streets and vote against something that's going to be against their own best interest? Why wouldn't they? It's sad. It's sad. It's a sad state of affairs in California. Not the California that I grew up looking at and saying, you know what? That's an awesome place to go to. Let me know what y'all think inside of the comments. Make sure y'all tap into the Patreon. Link is in the description. Teach Henley 40% off your first order, 20% off of life. I love you. I appreciate you. I'm going to holler at you guys later. It's a sad state of affairs.
So I don't even know where to begin. People are attacking me because I refuse to stand with Carmelo Anthony. Let me be very clear. Let's get something straight, okay? I don't care what skin color you see on me. I am not defending somebody just because they are black. I am not defending somebody just because they simply share the same skin color as me. That is straight up racist. Carmelo Anthony He stabbed and killed a young teenager. And you want me to stand with him just because he's black? Are y'all freaking crazy? Somebody's son was killed, murdered in cold blood. Somebody lost their son. Somebody lost their brother, their nephew, their grandson. And you don't care because he's white? You are racist. If you think it's okay that this young white teenager was killed because he is white, you are freaking racist. And you should freaking mirror, because you are full of hate. That is straight up evil. But I'm supposed to stand with Carmelo Anthony just because he's black. No, I'm not. He shouldn't have had a knife at school in the first place. Miss me with the he was being bullied. Bull crap. Do you not know how many kids at school get into it with each other? They fight, they argue, and they don't stab each other. It happens. He should not have brought a knife to school in the first place. He was up to no damn good. And miss me with the 10th? How can you be a black man and not defending this black baby? Black babies don't stab people. Miss me with that black baby shit. Excuse my language, but I'm sick of this shit. People coming after me all in my damn inbox, threatening me, talking about I'm betraying a young black man. I don't owe Carmelo Anthony a damn thing. How the hell am I betraying Carmelo Anthony? Because he's black? I don't owe him allegiance because he's black. I don't owe him any damn loyalty. The same people who are defending him just because he's black and they don't care because he killed a white boy, them the same people who be accusing white people of being racist, well, your ass is racist too. I know I'm black, but I'm human before any damn thing, okay? I am human before anything.
We are America Mission. Make America your mission.